I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
It's a mixed picture here in pre-market trading as investors are digesting the latest reading on inflation. Producer prices unexpectedly declining in the month of May, falling 0.2% from the prior month. So let's get right to it. The three things that you need to know this Thursday morning as we prep you for the trading day. We've got Yahoo Finance's Jared Blickery, Alexis Keenan, and Madison Mills. Have more.
Thank you, Shauna. Stock futures in the green on the back of another key inflation print. The producer price index falling 0.2% versus a rise of 0.1% that was expected. Now, this comes after the Federal Reserve held interest rates at a 23-year high on Wednesday. Fed Chair Jay Powell saying the timing of the rate cuts remains uncertain as the central bank scaled back its estimate of a cut this year to 1 from 3 previously.
Plus, we're on Tesla watch. Tesla shareholders will finish voting on CEO Elon Musk's multi-billion-dollar compensation package and a move of the company to Texas. Musk is saying in a tweet last night, that the votes cast so far favor both proposals by, quote, wide margins. Tesla shares we're watching today.
And Broadcom passing the AI euphoria test, shares of the company surging after the chip supplier for Apple and other tech titans topped analysts' second quarter expectations. That's been driven by robust demand for its AI products. Broadcom is on track for its biggest gains in 4 years today.
Tesla shares moving higher this morning after CEO Elon Musk says he's prepared for victory in his pay package battle. Musk taking to X, posting, quote, both Tesla shareholder resolutions are currently passing by wide margins. Alexis Keenan, Yahoo Finance's own, joins us with the latest here. We're taking a look at the X post here. Alexis, what could this all mean here?
Yeah, so Musk putting this out there for the public to see, saying that it looks like he's expecting both of these measures to pass. So
not normal by any standards.
Not by any standards, no. And this was late last night. Both the move to Texas and his pay package. And you had then Dan Ives at Wedbush saying that a yes on pay would remove what he thinks would be a 20 to 25% overhang that's been on the stock ever since this court decision came down invalidating the package. You've got major shareholders putting in their votes. You have some reports out there that BlackRock and Vanguard have expressed their blessings to this package. So that's why you would see a big spike in those tweets that Musk put out there. Is a lot of times these major shareholders, they wait to the last minute to cast their votes, and then boom, we see some action there at the tail end. So you have ARK Investment, you have Barron Capital, FRS, all saying they are for this package, against. You have the pension plans, CalPERS, CalSTRS, and then that report from New York Times' Deal Book saying that Vanguard and BlackRock were voted yes. Vanguard, for its part, 7.32% shareholder. BlackRock at about 6%. Musk, the major shareholder in Tesla, but he doesn't get a chance to vote on his own pay package here at around 13%. So that is out of the mix. Now, you have the stock really, as you saw there, kind of suffering ever since this deal. And the analyst version of this is that if it's a yes, that we'll see a pop in the stock price. So that's why you're seeing and expecting some action here. Question though, what will the Delaware court do regardless of what the vote is? If it's a yes, it doesn't mean this is a done deal. This whole thing could end up at the Delaware Supreme Court if the judge does not think that Tesla and its process and how it put this vote back out to shareholders was insufficient in some way.
All right, we're going to get a final result on that vote from Tesla's annual shareholder meeting this afternoon. Alexis breaking this down for us. And as we're waiting for that final result this afternoon from the Tesla shareholder vote, our next guest is feeling bullish ahead of the final vote, raising his price target from $200 to $230 and reiterating his buy rating. Garrett Nelson, CFRA research analyst, joins us now to discuss. All right, Garrett, take us into your thesis here. I mean, we've seen the shares drop precipitously here since the original pay package was voided. So what makes this that much different now that we have this potential shareholder vote? And do the fundamentals for the company change?
Sure. Thanks for having me. Well, this really would remove a major overhang on the stock that's been lingering for weeks and months now, ever since the Delaware court ruling came out. So in our view, it's not surprising that the shares are currently trading about 7% higher in the pre-market. In a worst case scenario, if this was not approved, if his 2018 compensation plan was not reapproved by shareholders, given the diversity of his business interests, especially at this point, now that he owns X and is re-involved with AI, with the XAI again, we could have seen a scenario where he could potentially have walked away from the company. So,
would he really?
So investors are really sending a message that they want the company to stay the course.
Would he really have walked away from the company?
We think it's a possibility when you consider that he, the 6 businesses that he's involved with, not all at once, but perhaps over time, selling his remaining shares and moving on. But when you look back at his 2018 compensation plan, it was entirely incentive based. There was no salary. And he's really delivered for shareholders over the last 5 to 6 years. And so I think that's why you've seen just this week a number of very large investors come out in favor of this, because Elon's incentives are really aligned with the interest of shareholders. And in fact, he has delivered on those very lofty thresholders from the compensation plan. And so I think what you're seeing is the overwhelming support of retail investors for this. And really, he just needed a fraction of support from institutional investors, which it appears that he has gotten.
Garrett, there has been, though, concerns out there from shareholders really over the last several months, last couple of years, just about these distractions that we have heard when it comes to Musk, when it comes to his other business interests. Are any of those concerns warranted, do you think?
Of course. You consider someone who owns a half dozen very large businesses, such as Elon. But, in our view, if anyone is capable of that juggling act, it's him. And he's shown that over time. You look at the total returns since the compensation plan was approved, the stock is up more than 1,000%. And so I think there's a recognition, appreciation, especially on behalf of retail investors, that he has helped deliver for them. And so now it's time for them to deliver for him in that compensation plan that was agreed upon 6 years ago.
Okay. And so as we're looking at all of the different undulations for Tesla's share price and the activity, this environment that Tesla is in is far different than years past and the returns that investor shareholders have seen before, especially with the demand generation cycle that all of the automakers are trying to navigate through right now. So what does this next leg for growth potentially, if Elon Musk sticks around, if this shareholder vote goes his way, what does that look like?
Sure. I think the past 5 or 6 years have been about volume growth. And the next 5 or 6 years are really going to be more about AI and Elon delivering on this promise of fully autonomous driving. In our view, Tesla is leading the autonomous driving race and is going to get there first in terms of fully autonomous driving. And so, given the heavy investments that they're making in AI, and we think that that's going to really show up with every subsequent update of their autopilot software, full self-driving. You see material improvement in the quality of what it's able to do. And so we think that's really going to set the stage for the next 5 to 6 years. It's be more about delivering on that and them actually bringing a robo-taxi to market.
And Garrett, real quick, while we have you, there are headlines crossing this morning just regarding the pricing of Model 3s in Europe. And this, of course, being brought up on the heels of the expected tariffs that are going to be implemented on cars that are manufactured and produced in China and then brought to the EU. What do you think that's ultimately going to do for demand? And how big of a headwind do you potentially see this being here for Tesla, at least for its sales in Europe?
Yeah, certainly a headwind. The good thing about Tesla is they're very much Western market based. Of course, they have the plant in Shanghai, but the bulk of their sales are in North America and in Europe. And so, they're in a different position than they were a few years ago, in that they now have a factory there in Europe, so they can mitigate the impact of those tariffs with their factory in Berlin. So I think they're in a better position to navigate those tariffs than they were previously.
All right, Garrett Nelson, always great to talk to you. CFRA's research analyst. Thanks so much for hopping on with us this morning.
Thank you.
And stay tuned for our special coverage of Tesla's shareholder vote. That's from 4:30 to 5:30 p.m. Eastern time today. Julie Hyman and Josh Lipton will be speaking with ARK Invest CEO Kathy Wood. You won't want to miss that. Another big story that we're tracking here at Yahoo Finance, futures are mixed here this morning on the back of another key inflation print. We got producer price index out this morning, unexpectedly falling about 0.2% in the month of May. The reading coming on the heels of yesterday's comments from Fed Chair Jay Powell, where he once again reiterated more data is necessary before feeling comfortable about cutting rates. Here's what Chair Powell had to say.
We'll have to see where the data light the way. You know, the economy has, repeatedly surprised forecasters in both directions. And
all right, we want to bring in Krishna Guha. He is Evercore ISI Vice Chairman here. When you take a look at what is happening right now and some of the comments that we heard from Fed Chair Jay Powell, does it make sense in terms of remaining so data dependent and balancing that risk here and potentially going too far? What do you think?
Well, of course you're right. It's a balancing act for the Fed, right? They don't want to declare victory too soon and cut rates. They don't want to hang around at 5.5% for too long and find that they end up blowing the soft landing. So that's been the balancing act for a while. It's still the balancing act right now. What we heard from the Fed yesterday was, thumbs up, the last inflation print was good, but one print, not enough. We need to see a more sustained downshift in inflation over several months to build that confidence that in the balancing of those risks, the time has come to cut rates.
Do you think the Fed should be as stringent as it is about getting inflation to 2%?
So I think the truth is that the Fed will be fine about taking a couple of years to get all the way down to 2.0 on their preferred measure, the PCE deflator. But what they want to make sure is that they're not getting stuck at 3. Late last year, everything was looking fantastic. They were teeing up to go in June, remember. They were going to go at this meeting this week. 3 cuts this year. And then we ran into that unexpectedly hot patch of inflation data. So they're just trying to check that the basic story is still on track. We are still heading down towards 2. We don't have to be in a real rush to get to 2.0, but we don't want to get stuck at 3.
Are you convinced that we are going to head on that downward path? And I guess how bumpy is that ride potentially going to be?
Well, bumpy is a loaded word, right? So I am optimistic that we are on that path. I think if you look at the labor market, at the economy more broadly, I think the economy's broadly back into balance. We've had a big assist from this massive supply of cheap immigrant workers over the last year and a half. So whatever you think about the larger political and social issues relating to that, from a narrow economics perspective, that's more labor supply helping to meet demand for workers. I think when you look at the inflation earlier this year, most of it, not all of it, most of it was in backward-looking categories. The official measure of the housing-related cost, the OER, still hasn't caught up to the step down in private sector rents. Vehicle insurance was running high because it was still catching up with the increase in used car prices beforehand. And there were various other things that were printing hot, but didn't feel like they were really a good guide to where inflation's heading going forward. So I am optimistic that we're heading in the right direction. I think it's reasonable for the Fed to say, okay, but I'm not just going to turn over one good card and say that's all right, right? I want to turn over several cards and check we're in more of a trend here.
So I guess just quickly then, what do you think the Fed needs to see in order to be convinced that it is okay to act?
So it's a holistic view across what's going on in the economy itself. The economists will use the term real economy, spending, employment, those kind of things, and what's happening on inflation. Inflation is first among equals. They want to see that downshift in inflation. So let's say 3, at least maybe 4 really good months on inflation, like the one we just got in May. But they're also paying attention to what's going on in the economy in general. If the economy is rip-roaringly strong, they'll ask for more proof on inflation. If the economy is showing more signs of weakening, which I think is more of the tone of some of the data recently and some of the market signals, there'll be a little bit more give on the inflation front.
The Fed, in all of the cards that you were mentioning, that they turn over and are looking for something very specific, and that to really show them a trend more broadly that they're looking at. Is there forward-looking data instead of all of this backwards-looking data that they should be considering?
So you're 100% correct that policy has to be forward-looking. And the type of risk management that the Fed needs to conduct has to be forward-looking. It's not enough to say, oh, well, last month the payrolls were fine.
Right.
Or last month the spending was fine.
Is there something that
the
gives a
issue
better
is where are we
pulse?
going forward?
Right.
So the problem is that in this post-pandemic world, it's been very hard to forecast the economy, right? Stuff's been happening that isn't familiar, and we don't have a good sense of how to model this. So inevitably that makes the Fed and other central banks lean a little bit more on the actual data as opposed to forecast. But I absolutely agree with you that policy needs to be forward-looking. You can't get trapped in just looking in the rearview mirror. What I think the Fed can reasonably say is we want some minimum confirmation in terms of the current run rate of inflation, that things are moving back in the right direction, and then we pivot to that more forward-looking view.
What do you think about some of the softness that we're starting to see within the labor market? When you take a look kind of the divergence of what we got with the household survey versus establishment survey, we had that unemployment rate right now, right around or at 4%. That risk here that could start to slide and we could then see further weakness within the labor market. How likely is that? And I guess the risk that then ultimately poses when we're talking about the Fed maybe needing to be a little bit more convinced before they feel comfortable cutting. And maybe that's exactly what they need to see.
So the Fed has said that they wanted to see the previously tight labor market ease off a bit. What we've seen up to this point, with unemployment edging up to 4%, still looks like the sort of desired easing off of things a bit, and not the scary, oh my God, unemployment is shooting higher type of thing. But, as in all fairness, Powell himself acknowledged yesterday, if you wait until you get that big spike in unemployment, you've screwed up. Yeah. Right? So you can't say, well, okay, but we're going to wait until that happens. No, you need to try and act in a way that prevents that from happening. Now, payroll survey versus household survey, truth is probably something a little bit in between, but I do think that the payroll survey is probably a better measure of job creation at this point in time. It generally is, but also when we have this big influx of immigrant workers, that's probably getting better captured in the corporate payrolls than the household survey, because the household survey isn't being scaled up in a way that fully captures the amount of new immigrant workers that have entered the U.S. economy in the last year or so.
As we have you here, can we compare what the Fed is doing versus some of the other central banks around the world? You're also watching Friday's Bank of Japan decision here. And of course, we'd already seen the Bank of Canada, perhaps less significant than the Bank of Japan. But anyway, we saw them trim rates last week. So what the Fed is navigating through right now within their own policy decisions versus what we're seeing around the world.
Right. So I basically put the central banks in 2 buckets. There's Japan and there's everybody else, as there has been for a while. Yeah. So what Japan is doing, remember, is Japan is working its way out of that multi-decade period of very weak inflation or outright deflation. So for them, the question is, have we seen enough to prepare for our next rate hike? Right? They did their first hike out of negative rates, you'll remember, a few months back. I think what they're going to do, and we're going to find out pretty soon, is they're going to trim their QE purchases a fraction, and I think they're going to hint that next hike is coming potentially as soon as their July meeting, but not later than October. So in the next few meetings, they're going to be making that next move up on rates. In Europe and in Canada, it's more of a situation like the US. Rates are high because inflation has been high. When have we seen enough to start bringing rates down? So the European central banks, possibly the second most important central bank in the world after the Fed, they of course cut rates for the first time in June. They're sending us a cautious signal, not pre-committing to anything else. But I think their basic plan is that they would go another 2 times this year, provided that every time they rerun their forecasts and so on, they confirm that inflation is on track. Per your earlier point about the Fed needing to be forward-looking, the ECB is precisely telling us right now that they don't want to be too data point dependent. They have a forecast that inflation is going to be, in their case, right back at 2 next year. And so they want to start walking those rates back this year carefully.
All right, Krishna Guha, always great to have you. Thanks so much for joining us here in studio. We hope to have you back again soon. Evercore's Vice Chairman, thanks so much. Well, Broadcom shares surging after posting a beat in the second quarter, also announcing a 10-for-1 stock split, which is set to take effect July 15th. Now, the company is saying its AI products contributing to over $3 billion in sales during the quarter. We're seeing the excitement play out here in real time and pre-market action. You've got this stock up just about 14%. And Brad, when you take a look at these numbers, very impressive growth here from Broadcom. A number of analysts, we will be speaking with one later on in the show, raising their price targets as a result of this, some of that momentum that they're seeing within their AI business, specifically the fact that AI revenue was $3.1 billion, significantly exceeding many of those forecasts there from the street.
Yeah, some numbers on this quarter. Q2 revenue of $3.8 billion, that grew 44% year over year. 53% of semiconductor revenue is what that represented. And they said that this was driven by strong demand from hyperscalers for both AI networking and custom accelerators here. So also interesting to note within this, and they talked about this on the earnings call, that AI data center clusters continue to deploy here, and their revenue mix has been shifting towards an increasing proportion of networking here. And so doubling the number of switches that they sold year over year, particularly by what they call Tomahawk 5 and Jericho 3. We'll dive into that further. Perhaps we need a little terminology breakdown for some of these companies as we hear more about the chips and the hyperscalers and the switches, yada, yada, yada. But successful deployment of those, and some of their partners, Dell, Juniper, Supermicro, they're citing within this report, talked about them well on the call too.
All right, shares up just about 14%. Keep right here on Yahoo Finance. We've got much more coming up. Shares of Virgin Galactic sinking in the pre-market. They actually announced a reverse stock split. You're looking at losses of just about 12%. We've got that and some other top trending tickers when we come back.
Virgin Galactic shares sinking after announcing a reverse stock split. The space tourism company saying its board has approved a reverse stock split of 1-for-20 that's effective at 5 p.m. There you're taking a look at shares. They are down right now by about 12%. We should note that this is probably happening in order to make sure that they can keep their stock price above a certain threshold that's needed in order to not get a notice, a warning from the exchange that you trade on as well.
Yeah, they're doing this in the hopes of being able to remain listed on the New York Stock Exchange. When you take a look at some of that historical data here, stocks typically maintaining that minimum average closing price of at least $1 a share over 30 days to avoid being delisted. And taking a look at the stock reaction this morning, we're off just around 10%, I believe, just off a 12%. Yesterday, we actually saw shares sinking on the news. They were off as much as just over 30% at the lows of the day before pairing those declines. So again, lots of uncertainty about what exactly it looks like for the future of this company, the ability here to navigate what is expected to be a expensive couple of quarters, to say the least, as they move forward. And then also just ultimately how this is going to register with investors as well, because I think there's lots of questions just about the timeline for some of their lofty goals and how realistic those are at this point.
Yeah, you think of some of the launches, the flights. They just recently completed that commercial flight of the Unity spacecraft. That was over the past few days here. And so you talked about how expensive it is to send things into space. And of course, the goal is you bring some of these costs down if you do it frequently enough and you have reusable rockets. And so all of these things considered, Virgin Galactic, SpaceX, Blue Origin, all of these initiatives really targeted at making sure that there is more sustainability, that you're able to bring the costs down as well. But at least in the early innings of this, it's still going to continue to remain expensive right now. And that's what investors have really had to wrap their heads around with regard to a name like Virgin Galactic here, and whether or not we're going to see a large amount of continued spend have to move forward at this juncture, and how that would cut into it's going to cut into margins. There's no other way to slice it.
Yeah, and this is a stock that's struggled now for some time. This year, it's off over 60%, and then you compare that to the rise that we've seen in the S&P of just about 13%. So clearly a real underperformer here. Let's take a look at Boeing. That's another stock that's catching our attention here. Getting a bullish call from Bank of America. They raised their price target on the stock from $180 to $200 a share. The analyst behind that call saying that Boeing is, quote, too big to fail, but turning around operations is going to take some time. Maintaining that neutral rating that he has on the stock when it comes to some of those other tidbits here within this call here from Bank of America, saying that Boeing remains uniquely positioned to the robust air traffic demand environment with the moat that the duopoly creates. Although, again, reiterating the fact that some of those turnaround operations, that's going to take some time to play out, and there are uncertainties clearly that remain in the future. So because of all that, raising his price target given where Boeing is trading today, but still, though, staying on the sidelines when it comes to that rating of maintaining neutral stance on the company.
And we've seen in the past where, especially for the large plane manufacturers, where that duopoly that's in the system for those orders where it's largely either Boeing or Airbus at the end of the day, and where that can be a backstop for some of the share price activity too, and the slippage that we've seen in the past, even when Boeing has a tumultuous start to the year here. And so as investors are trying to best position themselves as to where they can see some type of potential bounce back for Boeing. I mean, we were just speaking with the CEO of La Compagnie earlier this week, and they had said previously, prior to this year and prior to some of the manufacturing shortcomings for the large plane order, just broader landscape, they were able to receive or bank on receiving a plane in about 18 months. That's drastically moved out, and it's changing the amount of fleet that companies, either as small as La Compagnie that has 2 aircrafts right now, or some of the other airline operators that have hundreds of different aircraft that they operate, are actually able to insert into their flight paths, their routes, and that impacting some financials and leading them to adjust, as we had seen earlier this year as well.
All right, let's take a look at Dave & Buster's getting a read on the consumer here, plunging after reporting that revenue fell 1.5% in the first quarter. Comp sales also falling during its most recent quarter, down 5.6% from a year ago. That was below the street's expectations, a bigger than expected fall. You're looking at shares drop of just around 9.5%. When it comes to some of the issues facing Dave & Buster's right now, they called out that uncertain economic environment. They also said that they logged more, quote, incremental labor and marketing costs. And they also mentioned the unsuccessful marketing campaign test here when we talk about some more higher price when it comes to new menus, the new service model, new technology here weighing on some of those results.
Only one comment here. If the Celtics sweep the series, that's not good for Dave and Buster's. You rely on them games. All right, everybody, you're taking a look at the Nasdaq and at the NYSE. Great group of folks ringing the opening bell. You've got Sila. Well, we'll workshop it. Realty Trust ringing the opening bell at the NYSE. And at the Nasdaq, you've got PAC, Professional Athletes Community, Pro Athlete Community, with the funfetti out there. I'm trying to see if I can recognize anybody in there. I'm squinting, so maybe that's on. Chip Pawsek. Wow, Chip Pawsek, formerly, oh my gosh, why is it escaping me? I'm gonna research that. That name sounds really familiar though. Former CEO of a major Nasdaq company back in the day. All right, so anyway, that's a check of the markets here. Let's take a look at the major averages to see where we begin things on the day. The Dow starts the day in negative territory. That's down by about 0.3%. The S&P 500, though, and the Nasdaq, they're holding on to gains to begin today's trading activity.
Yeah, when you take a look at the reaction that we're seeing following that PPI print, coming in with the biggest decline that we've seen since October, better than what the street had been looking for. We're seeing that play out in the equity markets here in the reaction right at the open, but also some of that movement that we're seeing within the bond market.
2U was the name of the company. Chip Pawsek, former CEO there. Yep. Or he might be the current CEO as well.
More knowledge to everyone, all of our viewers.
Yeah.
All right, let's get over to Jared Blickery standing by with a closer look at some of that movement that we're seeing here at the open, Jared.
Thank you, Shauna. Well, let's get the Wi-Fi Interactive cranked up behind me. We can see the Dow just down about 35 basis points or 139 points. But I want to check in on the 4-day price action. We've seen the S&P 500 and Nasdaq come off record highs. And you can see for the Dow, it's been choppy, and we're actually 0.5% down for the week. Very different story when you take a look at the Nasdaq Composite, up 3.4%. S&P 500 also in the green. And real quickly, the Russell 2000 as well. So looking pretty good on that front. And then if you take a look at the bond market, we have yields continuing to drop. That has been a tailwind for equities. And if we take a look at the sector action right now, we see tech, XLK, that is up another 1%. And guess why? We're going to move over to the Nasdaq 100 where we can see our heat map screen, and what jumps out, more bullish action in some of these mega caps, not all of them, but check out Apple. Let's see what it's done over the last 4 days, what it's done this week, up at 9%. That is a huge move for Apple, which only recently broke out of a long-term base. This is a three-year chart right here. And if we take a look at Microsoft, it's down just fractionally today, but let me just show you, it is also breaking out, not quite as long a base, but there we have it. You can see that breakout right there. And then I want to take a look at our leaders, and we can see actually Chinese stocks in the forefront, and also chip stocks are leading. So let me end on this. We're going to take a look at our semiconductors. Look at this, Broadcom up 13%, in addition to Nvidia's 3%. That should be good for a record high. Suffice to say that we've seen a lot of bullish action in some of these bigger chip companies recently, and we're seeing that continue today.
All right, Jared, thanks so much. Yeah, Broadcom shares soaring here at the open, on track for the biggest gain really that we've seen in just about 4 years if these current gains hold. All right, well, much more of Yahoo Finance here on the other side of the break. We're going to break down the latest read here on inflation, what exactly that means for markets, how the Fed is looking at these latest prints. We've got that for you when we come back. Stocks are mixed here to start today's trading session. You got the Dow still in negative territory. Treasury yields are falling. The moves coming on the heels of the producer price index that was released ahead of the bell, unexpectedly dropping in the month of May. The latest here, maybe some evidence that inflation is continuing to cool. We want to bring in Brent Schutte. He is Northwestern Mutual Wealth Management's Chief Investment Officer. Brent, let's talk about this data that we're getting out here this morning, what ultimately this means here for equities. We've seen almost this risk-on rally here over the last couple of prints as the market searches for any sort of good news within these reports. I'm curious what you think, what we heard from Powell yesterday, the likely timing here of the Fed, ultimately what that means for the equity markets here in the short term.
Yeah, well, I think investors are discounting too easy of a process. They think miraculously inflation is going to come down without causing or having the economy slow too much to cause a recession. They think the Fed is going to be able to miraculously cut rates and keep a slowing economy from moving towards a recession, which I think there was some data on the other side this morning. Jobless claims spiked to 242,000. Continuing claims are higher. And so to me, at least history would show that it's not usually an easy process. The Fed has trouble slowing inflation without causing a recession. And to me, that is still where we're looking at is right now, the good news on the inflation side doesn't mean the economy is slowing or not, which I still think it means the economy is slowing. And typically it takes a while for Fed rate cuts to actually work their way in the system, just like it does Fed rate hikes, which you're seeing right now.
Do you think then we're still heading towards a recession, Brent?
I do. I mean, I still think it's the most likely outcome. Certainly it's been stretched out, but there are parts of the economy that are wobbling already. The low-end consumer is hurting from credit card and auto loan debts. To me, the big question has always been, can rates come down quick enough to kind of pull back the impact of rate hikes, which are still working their way through the economy? If you think about the commercial real estate market, more and more that we go longer with rates higher, more and more properties are selling for large discounts from where they were. The longer rates remain higher, consumers continue to weaken under the impact of credit card and auto loan rates that are higher. And so I do still think you're likely to see a recession. It never has happened, at least in the past, without that being the case. This time could be different, but I don't think so.
So, Brent, then what are you advising investors to do right now? Is it time to stay defensive? Where are you seeing those opportunities?
Yeah, this is where I think you all say the market's moving higher, but do you all realize that over the past 3 months of this quarter, while the S&P is up, every other part of the market's down? And the S&P has been driven by the Mag 7, which are up 17%, while the rest of the S&P, 493 names, are actually down 2%. And so it's a very bifurcated economy. It's a bifurcated market. To me, parts of the market represent value. Value doesn't be a very good timing tool. It's not an instant gratification trade. But I do think fixed income provides value, even though I think you might have to have higher rates to get that recession. I think if you look at the 10-year Treasury, for example, I don't think people realize that if it rises 100 basis points in yield, you only lose 2% over the next year. If it falls 100 basis points, which I think is more likely through a recession, you get 12% total return. Small and mid-cap stocks trade at remarkable discounts to the S&P 500, which trades at 24 times historical earnings or 12 months earnings. And 22 times forward 12-month earnings, which are expensive. And so I think there's opportunities for investors. Unfortunately, they're not in places that people are looking right now.
And so as we're thinking about portfolio pivots, what is the playbook that investors should be enacting, if they haven't already, in line with what you were just mentioning, in some of the opportunities that are out there and perhaps the areas that they should be rotating out of that have already seen the run-up or the gains?
This is the hardest thing to do because it can last for some time, where you have a certain part of the market that's really narrow driving the gains forward, and people want to pile into that. And if you look historically, every economic cycle has had different leadership. And so an economic cycle from recession start to the start of the next recession, at least going back to the 1980s, every economic cycle's had different leaders. And the leaders of the past economic cycle typically become the laggards. Think about Japan in the 80s. It took 34 years to make new highs. Think about tech back in 2000. It took 17 years to make new highs. Think about China in 2007. It's still half of what it was. And so to me, the biggest risk that I think is that investors get attempted to concentrate in a particular part of the market. I think valuation matters, not necessarily in the near term, but in the intermediate term. And I think diversification still works, despite the narrative that I keep seeing more and more to the contrary from news outlets and articles that are out there.
Brent Schutte, who is the Northwestern Mutual Wealth Management Chief Investment Officer. Brent, great to see you. Thanks so much for taking the time here today, just after the opening bell.
Thanks.
Certainly. Everyone, we've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
Broadcom shares surging after posting a beat in the second quarter, also announcing a 10-for-1 stock split. We're looking at gains of just around 13.5%. The results driven by strength in VMware, also the company's AI products, which contributed to over $3 billion in sales during the quarter. Our next guest seeing these results as a big win here for investors. Joining us now, we want to bring in Stacy Rasgon. He is the Bernstein Managing Director and Senior Analyst. Stacy, it's great to see you here. So we talked about this blowout quarter, I think it's fair to say here, from Broadcom. I know you just raised your price target here on the stock. How much more bullish are you on this name following these numbers that we just got here from the company?
Look, I like this stock. I like Broadcom a lot. There's a few things going on. The core business is not great. It's cyclically weak. They're not the only ones right now, but they've probably reset it at this point enough. It actually sets the core business up really nicely for growth as we get in the next year. And in the meantime, they have this, what I always refer to as the second best AI story in the space. I mean, Nvidia is clearly number one. Broadcom is actually number two, and they make the custom chips that all the hyperscalers are developing for themselves, and they do AI networking. And in fact, there's only two companies where the AI growth is enough to cover up anything else. It's Nvidia and Broadcom, that's it. And so even though their core business has been weak, their AI business has been more than strong enough to sort of bridge that gap. They took that AI number up like this last night. I think the guidance for AI for them this year is quite conservative. They're suggesting $11 billion, which would actually only suggest about low to mid single digit growth, half over half, and actually a run rate that would be below where they were running in Q2. That's in my opinion unlikely to happen. They've got upside from VMware. They're executing on that acquisition really, really well, and I suspect there's upside as we get into next year as that business kind of grows and scales. And in the meantime, they've got the absolute best financial performance, free cash flow margins, everything else in the space by a country mile. And even though the valuation is elevated versus its own history, it's at a really sharp discount still to the overall space. And it's a different company than it used to be. It's half software almost. It's again, you have the great AI story. I still think the valuation is attractive too. I really like it.
Stacey, I want to follow up on that point that you just made there about their guidance. Maybe given the growth that they've seen within AI, this could prove to be a conservative guide. From the earnings transcript call, that also stuck out to me because you asked management point blank that exact thing. I'm curious from your perspective, your models, what do you think that potential growth rate could look like?
Well, I mean, they grew something like, I don't know what it was, 200% or something like this last quarter. I mean, it's a lot. I mean, now what they were suggesting on the call was, I don't think they're seeing it. They were just noting that for these compute offload chips that they make for the likes of Google and Meta, they only have a few customers. So there's always the potential for some lumpiness, and I think that's what they were calling up. But I didn't get the impression they were actually seeing anything. I do feel like they're just, again, it's a smart management team. They're trying to keep expectations in check, which is not a bad thing. But again, I mean, they've taken this up. I think it was $5 billion to $7 billion to $10 billion, and now it's $11 billion. I wouldn't be surprised to see that number exceed the current guidance as we go through the rest of the year. I wouldn't be surprised.
Stacey, what type of market share profile do you believe that they would need to achieve in order to hit some of your targets?
In which business?
Especially as we're thinking about the semiconductor landscape and the amount of networking that they're talking about on this call. I'm primarily thinking about that business where they're seeing the most growth, but the AI accelerators potentially is where I was considering.
They've already got pretty dominant share. So if you go through the businesses, so their wireless business, it's mostly Apple. And for the stuff that they sell into Apple, they're mostly sole sourced. It's RF and connectivity. Same thing in like storage, their market share is high. In broadband, it's cable modems and set-top, like their shares very high. In networking, just sort of traditional networking, it's a switching and routing. It's mostly them and Marvell. They're the 800-pound gorilla. On the AI ASIC side, it's the same thing. Their Broadcom is by far the largest here. Again, you have Marvell, you have a few smaller like Taiwanese guys, but Broadcom is already sort of like the big player here. Then, to be fair, these are the kind of businesses that they focus on. Hock Tan, the CEO, always talks about wanting to invest in franchises. Like, what does he mean by franchise? Dominant market share, good market structures, long revenue visibility, markets where customers are willing to pay for innovation. So he has pricing power as long as he's investing in the technology roadmaps. These are the kind of businesses that he looks at. All of their semiconductor segments sort of fall into those kinds of buckets. So their share is pretty good in all of these.
Stacey, what do you think this also just tells us about some of the excitement more broadly speaking within the sector when you take a look at the reaction that we're almost seeing here across the board on the heels of this print from Broadcom? Outside of Broadcom, obviously outside of Nvidia, what are some of the other names that you still view as those top plays here within AI?
Yeah, you bet. And so, by the way, Broadcom's up today, I think, because, again, they took up the AI numbers. I think the AI guide is conservative. They also have this 10-for-1 stocks, but which I'm always a little hesitant. I feel like fundamentally it shouldn't drive anything, but in practice, clearly that's probably helping some today. Other names that I like on the AI side, our top picks right now are Broadcom, Nvidia, and actually Qualcomm. Qualcomm has the benefit of, their core market smartphones have kind of hit bottom, which is good. And I'm actually getting more excited about the AI opportunity at the edge for them. Not even so much thinking about like upgrade cycles, although that could happen. It's more for them even just content. Content is enough, I think, as AI functionality rolls out. And they've got some option value there. They're trying to get into the PC market and other things. But I'm actually liking Qualcomm as a broader AI play, like at the edge rather than just in the cloud.
Certainly. And there we're taking a look at some of the stock moves here on the day. What do you need to hear from management on a continued basis to ensure that they're marching towards exactly how you and some of your peers are growing even more optimistic on them right now?
Yeah, I mean, look, keep doing what you're doing, right? I mean, that's if I can keep hearing what the kind of stuff that we've been hearing over the last several quarters, I mean, that'll be more than enough.
All right, Stacy Rasgon, who is the Bernstein Managing Director and Senior Analyst. Thanks so much for taking the time, Stacy.
You bet.
A bearish call on crude oil next year. How low can commodity get? We discuss one bank's base case right after the break. Stick with us. A bearish call on crude from Citibank. The bank forecasting Brent will hit $60 per barrel in 2025 and crude inventories surging by 1.4 million barrels per day next year. This after OPEC members announced plans to bring 2.5 million barrels per day back to the market in 2025. The bank citing slowing demand, increasing energy efficiency, and more EV versus oil and gasoline usage as headwinds for the commodity here. You know, I was interested in seeing whether or not we would have gotten some type of AI data center mention as well within here, considering the amount of times we're increasingly talking about utilities being necessary to power even more of these data centers that are going to go from potentially 60,000 chips, as we've seen in some cases, all the way up to 1 million chips. That means more demand potentially for oil as well.
Yeah, I think there's lots of questions just about what exactly that is going to look like. When we talk about the biggest drivers here, I think this just simply comes down to supply versus demand. And the supply factors, the updates that we've gotten here from OPEC, especially when you take into account by 2025, we are expected to have a surplus here in the global market. And pairing that with the projections of the forecast that we got from IEA yesterday, Citi's actually recommending that oil producers start to hedge against any of these potential price drops, and that investors view any short-term price rise in the short-term price here as an opportunity to maybe take some of those bearish conditions. So they're actually expecting a pretty substantial drop from where we are trading today, right around $78 for crude. They're expecting that to fall all the way to 60. So again, when you take into account some of the prediction there, the fact that demand clearly, when you put it up against supply, the surplus of supply is really going to be that clear driver here for prices. So Brent crude again slipping, at least Citi views, all the way down to $60, and they think that that's a real possibility.
And there's also a geopolitical implication within this as well. I mean, 2025 could hold a vastly different geopolitical landscape than we have right now, especially considering the fact that more than half of the world is expected to participate in global elections this year. And so as that takes hold and as we get even more of those results, it's going to come back to how different countries are viewing their role in energy production and in oil production as well. So it's going to be also that factor layered into us actually getting to this prediction that Citi has laid out here today.
All right, well, keep it right here on Yahoo Finance. We've got much more coming up. The Fed signaling 1 cut this year, but bond investors still pricing in 2. That's according to the latest data out from Bloomberg. We are going to discuss what the Fed's path forward means here for the markets. Plus, Tesla could soon be incorporated in Texas, according to Elon Musk. We're going to dive into what that change could mean here for the company, ultimately what the votes today means for investors. We got all that for you next on Catalyst.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Producer prices reporting a move to the downside, a decrease of 0.2% from the month prior. And jobless claims rising to a 9-month high. We'll ask Chief Economist Mohamed El-Erian how today's data could impact the Fed's outlook.
Plus, Elon Musk claiming that he has the votes from Tesla shareholders to approve his pay package, as well as the company's move to Texas. We're going to discuss what this could mean for the EV maker and its investors.
And chip stocks surging alongside Broadcom leading the way today after announcing a 10-for-1 stock split on their earnings. We're going to discuss how much more room these chip names have to run.
But first, we have to talk about today's big story, and that is inflation and the Fed. Producer prices seeing their biggest decline since October. This coming after consumer prices cooled more than economists had expected in the latest report yesterday on Wednesday. Still, the Fed remaining cautious, only forecasting one rate cut this year. When asked about the risks of waiting to cut rates, here is what Fed Chair Jay Powell had to say.
We understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks.
Joining us now, we want to bring in Mohamed El-Erian. He is Allianz's Chief Economic Advisor, as well as our very own Julie Hyman here joining the conversation as well. Mohamed, it's great to see you, and thanks so much for taking the time to join us. I want to start with what we just heard, that soundbite that we just played here from Fed Chair Jay Powell. He's saying that the Fed is acutely aware of the risks here to both sides, saying that the Fed, once again, reiterating remaining data dependent. I'm curious, though, of that downside risk of the Fed waiting too long. What exactly do you think that could look like, and the odds of that actually happening at this point?
So I think Chair Powell is correct in pointing out that there are two tails to the soft landing. The soft landing is what he's targeting, but there are risks on both sides. I think what he misses is the balance of that risk, that the balance, unfortunately, is in favor of them being too late and the economy slowing more than it should, and small businesses and low-income households being hit particularly hard. You ask, what is that probability? I put it at 35%. There's a 35% probability that they may end up too late. Now, the good news, it's not above 50, but it's a pretty fat tail that the Fed should be very, very attentive to.
Mohamed, it's Julie here. It's great to see you. So at this point, when is too late? Do we have a decent idea of the timing of when the Fed should begin cutting and when it actually is likely to begin cutting?
So in my opinion, too late is what is reflected in yesterday's SEP or dot plot, which is the possibility of one hike. And let's remember, 4 people said no hikes. And if this is the normal Fed hiking cycle, that one hike would come in December. So that, in my opinion, would be too late. By that time, the lagged effects of what was a significant increase in rates would be biting even more. Already, the cushions that small businesses have and poor households have already been eroded. Pandemic savings have gone. Debt levels are high. Delinquencies are going up. So I worry that if they carry through on what is in the SEP, that will be too late. Now, the good news, Julie, is I strongly believe that they had the CPI data a couple of days earlier, and they had today's PPI data, we would have gotten a different SEP.
And while you're mentioning the SEP as well, you say if they carry through. Well, we know that, the SEP, we sort of take it as a very loose guide. I think Powell himself has sort of alluded in that direction. So, I mean, how should we as investors read it?
Well, we should read it as the markets are reading it today and yesterday. Ignore it. That's exactly what the market did. If the market had taken it seriously, it would have seen first 2 cuts go to 1. It would have 3 cuts go to 1. It would have seen 4 people expect no cuts. It would have seen a higher inflation forecast for this year, and it would have seen a higher estimate for neutral rate. That's a real hawkish tilt. But the market, for the reasons you've cited, are saying, well, you know what? I'm going to ignore that. And that's why we're seeing the rally in both fixed income and in equities. And I think that's the right thing to do. There's part of me that thinks that the SEP is excessive transparency, excessive communication.
Well, they are excessively communicating, Mohammed, but not always the same message. We heard a lot of dissent, and we saw a lot of dissent in that dot plot in particular. So I'm curious from your perspective, if you think the Fed has lost the plot a little bit, and given the amount of dissent amongst the voting members, is that potentially more harmful than helpful at this point?
Lots of people think that. And if you look at the questioning yesterday, the chair was really pressed on, wait a minute, this doesn't make sense. I think what you're getting is the consequences of what I call excessive data dependency. The Fed made a very big mistake in 2021. They took a forward-looking view of inflation. They said inflation was transitory. They held on to that belief for too long. And as a result, we had a massive hiking cycle, including 4 consecutive hikes of 75 basis points. So I think they were so shaken by that mistake that they became just backward looking. And this is an excessively data-dependent Fed. When data itself is very noisy, which it has been, and the market has reacted up and down in terms of yields to that market, to that data, that volatile data, they end up coming across as confused. What the Fed desperately needs is to have the courage to take a forward-looking view of what the economy is going to do and stick to that view and anchor the markets better.
I think Nick Timiraos in the Wall Street Journal called it inflation PTSD in his discussion of the Fed and its mindset right now. Mohammed, the last time we talked, you said, when you're looking at all this backward-looking data, one of the places you go to find sort of more forward-looking data is actually company conference calls, earnings calls. And I'm curious, since we last spoke, what you are gleaning from those calls.
What I'm gleaning is what the forward-looking indicators are telling us, as opposed to historical data, is that demand is weakening. You hear it over and over again in the different corporate calls. You see it in sentiment. And that's why I think that the risks that we started this interview with the Fed chair clip is asymmetrical, Julie. I think there's a much bigger risk that we weaken faster than the Fed expects, than the other risk that inflation ends up much higher than the Fed expects.
Mohammed, are you concerned about some of the weakness that we are seeing within the labor market? And we talk about how maybe much more of a focus the Fed should or maybe will be placing on some of the softness that we have been seeing. What are your thoughts there and just the risk that this ultimately poses here, obviously, to the broader economy?
No, I worry about it. And I worry about it, Shona, because there are no buffers anymore. If you are a low-income household, if you are a small business, you're highly reliant on whatever income you're generating. You no longer have the buffer or the access to the debt markets that you had before. So that if something goes wrong, in the case of household, it would be if something goes wrong in the labor market, then it will not be linear. This economy will not weaken in a linear fashion. It risks weakening in an accelerated fashion. I look back at different hiking cycles and followed by cuts. And the one that soft landed in my lifetime, and I'm old, is 1995. And there, the Fed cut pretty early. All the others have ended up in bad news because the Fed tended to be late. This data-dependent Fed, because it's so backwardly looking, is so reactive in its reaction function that it risks being really late.
Mohammed, I want to end by asking you about something we talk about a lot with regards to those company earnings calls that Julie mentioned, which is the AI boom. And there's this idea that AI is going to drive so much corporate efficiency moving forward. How much do you factor that idea into your overall macro outlook?
I certainly factor it when I go beyond 1 year to the 3 year and the 5 year. What AI can do to productivity gets translated into bigger but not hotter. It will allow us to grow more, faster, but it will not mean that there'll be a speed limit in terms of inflation. The speed limit will be better than it is now on there. Now, there are labor consequences. There's all sorts of other things we have to pay attention to, but it is truly a productivity enhancing tool that will move the supply side in a favorable way and that will allow us to grow better over the long term.
All right, Mohammed, we're going to have to leave it there. Thank you so much for joining us. That was Mohammed El-Erian, Allianz Chief Economic Advisor, and thanks to our own Julie Hyman for bringing us this interview as well. Well, Treasury yields are falling today as investors react to cooling inflation data. Now the Fed and the bond market once again split on rate cuts moving forward, as the FOMC's new projections signal there may be just one 25 basis point cut this year. Most bond traders are pricing in about 50 basis points of cuts. That is according to the latest data from Bloomberg. So joining us now to discuss this is Bridge Karana, Wellington Management Fixed Income Portfolio Manager. Bridge, thanks so much for being here and sticking with us.
Thank you for having me.
We appreciate it.
Yes, thank you.
So we've been talking about this kind of bifurcation that we're seeing in the dot plot versus what the market is pricing in.
Yeah.
Who's right?
So I think the market's right. You look at what the Fed did yesterday. They, as you mentioned, they signaled only one cut for this year, and then they even took out one cut from next year. And you could say, well, that's pretty hawkish. And yet bond yields were pretty much unchanged after the Fed meeting. And I think what is hidden in that is the summary of economic projections. So the Fed said that they expect inflation to end this year at about 2.8% year over year, and they expect the unemployment rate to be about 4%. Well, guess what? That's where we're at right now. And so it begs the question, if data deteriorates more than that, inflation comes down, the unemployment rate rises further, which we certainly think it will, then that one cut could easily become two.
Yeah, I'm curious just how realistic you think some of those expectations are, specifically what you just mentioned about the unemployment rate here, really maintain and being able to stay here at 4%, and ultimately here what investors need to keep in mind given that risk.
Yeah, I mean, there's two surveys on the labor market. There's the establishment survey that we all look at every first Friday of the month, and that's been quite strong. But then you look at the household survey, and that actually lost about 400,000 jobs last month. In the last 6 months, the household survey has underperformed the establishment survey by almost 2.3 million jobs. And so, we look at forward-looking indicators of the labor market. Quits rate suggests that there's not as much wage pressure as people think. Job openings have come down. And so, like Mohammed was saying before, I do think that the unemployment rate could rise more than people think. And, I think the Fed is in this tricky spot right now where Chair Powell did acknowledge that this is a two-sided type situation. But the reality is they are much more focused on the inflation part of their mandate because they look at the unemployment situation and say, this doesn't look that different than where we were pre-pandemic.
And I keep wondering too, and Mohammed had touched on this, the idea of the lower income consumer starting to really struggle. That obviously coming up a lot in company earnings calls. But at what point does a K-shaped recovery lead to a broader economic problem if we're not seeing that in the data at all?
Yeah, it's a good question. I think this is the fundamental debate that we hear in the economic community is, are policy rates restrictive or not? You have Larry Summers say they're not restrictive at all. Look at how good growth is. And what I would say is if you look at real growth since the end of 2019, before the pandemic, we've grown at about 2% annualized, which is okay. Prior to that, it was 2.6% annualized for the prior 4 years. So growth has actually been slower. Productivity has even been slower despite all the enthusiasm about AI. And so I guess we've delayed the impact of rate hikes because of so much consumer stimulus, because of a fiscal deficit that reached 1.7 trillion last year. And as that slows, I think we're going to reveal that the neutral rate or the real rate for the economy is probably not that different than it was pre-pandemic.
So, Bridget, I'm curious, given all that, how have your conversations then with clients changed? And ultimately, are they staying on the sidelines, then waiting for the Fed to cut?
So the most common refrain I hear is, once the Fed starts cutting, then I'll buy bonds. And, that works. But at the same time, I do think that when you really want to buy bonds and extend your duration is when data is slowing. The central bank should be cutting, but they're not because they're worried about something else. Because in that way, they're reinforcing the negativity of the cycle because they're not cutting enough. And so, we're used to cycles where the Fed policy rate kind of takes the escalator up and then the elevator down. And I think we have to get used to the elevator went up in terms of policy rates, and it's probably going to take the escalator down. And so I do think there is this risk that the Fed is more behind the curve than people think. Even if they are cutting rates, they're not going to cut it as aggressively as we assumed in prior cycles.
All right, Bridge Corona, it's great to have you here in studio. Thanks so much for joining us here. Wellington Management's a fixed income portfolio manager. Thanks so much, Bridge. All right, well, turning now to chip stock. Shares of Broadcom surging today after announcing plans for a 10-for-1 stock split, also reporting another quarter of strong demand driven by its AI products. Yahoo Finance, we spoke to Stacy Rasgon, Bernstein Managing Director and Senior Analyst, about Broadcom's business and that blowout quarter that the company just had. Here's what he had to say.
They have this, what I always refer to as the second best AI story in the space. I mean, Nvidia is clearly number one. Broadcom is actually number two.
So he thinks Broadcom's the second best AI play, which is really what stuck out to us here, Maddie, from that conversation that we had just last hour. But I think that rate of growth, right? And this is something that Stacy asked Broadcom's management on the earnings call last night, and something that he discussed here with us on Yahoo Finance today. And just given that growth rate that we have seen, that demand, he still views, and I think this is many on the street view this as well, pretty much consensus, that management's guide here, even for the coming year, still proves to be a bit conservative, given the rapid growth rate that we have seen in demand for Broadcom's AI products specifically. So I think given that, we are seeing a number of analysts come out extremely bullish on this name here. And more you're starting to hear, even from our conversations with strategists and analysts over the last several weeks, you're starting to hear Broadcom's name brought up more and more as one of those top AI plays and well positioned given the excitement surrounding the technology.
Well, it was a great interview that you have with Stacy. I loved listening to it. And it was interesting because it also points to this idea that Nvidia, their customers are also their competitors, but the CEO of Broadcom throwing cold water on that idea, kind of saying, we're truly not a competitor, we don't want to be. Whether or not that remains to be true for a lot of Nvidia's customers is a big question I have. I know when I've been speaking with AWS and their chips lab creators, and I was on the ground in Austin with them, they talked a lot about this idea of, no, we don't want to be Nvidia's competitor, of course not, but also someday, of course he would want to be, right? So it's interesting to see. And of course, as Stacy mentioned, the fact that he sees this as the second biggest AI play, regardless, not a bad comparison.
Not a bad comparison. And you're also looking at Broadcom shares. They have been up just around 15% here earlier in trading, on track for one of its best days that it's had, or the best day that it's had, going back to 2020. So again, we'll see if those gains hold. We can say we're just off the highs of the session here, with shares up just about 12%. Coming up, keep it right here on Yahoo Finance. We've got much more on Catalyst on the other side of the break.
Tesla shares moving higher this morning, up over 4.5% after CEO Elon Musk says he's prepared for victory in his package battle. Musk taking to X, posting, quote, both Tesla shareholder resolutions are currently passing by wide margins. So joining us now to discuss the implications, we have Zohar Goshen. He's professor of transactional law at Columbia. Zohar, thank you so much for coming in studio to discuss this big day in Tesla world with us. We appreciate it. I just want to get your context and legal perspective to start it off here. How kind of unprecedented is this, given the fact that the court sort of already ordered a remedy to Elon Musk's pay package?
It's not a routine decision to do that, but I think it's an appropriate one to take, given that when they approved in 2018, when they approved the compensation package, they approved it through the special committee, which is a group of independent directors, and then shareholders vote. And what the court said, the court basically said that the approval by the special committee was ineffective because they were conflicted and because there was a lot of pressure from Musk. So that killed that process. However, the court also said that because they didn't disclose to the shareholders that the special committee was conflicted, then the vote was also ineffective to approve the package. So both of them dropped, and the court decided that the package is invalid. So what they did a procedure that is known in law as called ratification. We did some error, we want to fix it, and here is how we're going to fix it. We created a new special committee, and we are letting you know about all the flaws that happened in the process, and you can decide whether you want to approve it or not, and we will know today whether they approve or not.
Exactly. And I guess my question is, we're expecting it to be approved, and I say expecting it just given what we've heard from Elon Musk and the statement that he put out on X earlier. But I guess if it is not approved, what are the options then for Tesla? What are the options for Musk? What ultimately then would happen next?
So there are several options. Either it's approved or not approved. And if it's not approved, what it means that they will stay in Delaware court. They will wait for the ruling about the attorney's fee, and they will appeal. They will appeal to the Supreme Court in Delaware. Another option that they have, now they have tried to approve it as a ratification, meaning we want to approve the original decision. But they can have a different decision, a new one, in which they will, again, form a special committee. And then they might agree, let's say, if it's not 50 billion, it's 46 billion, whatever number that the special committee will arrive. And then they would bring it to the shareholders. And if the shareholders will approve it, then he will get the new compensation package. That's if it's not approved. These are the options that they have.
I guess my question is also just for viewers out there, when we're trying to think of exactly what this means here for shares. We spoke to an analyst last hour saying that if this is approved, that would be good news here for shareholders. We'll likely see some excitement surrounding this vote. But I guess in terms of that catalyst, when you take a look back at maybe other companies that have dealt with not this exact issue, but a similar type of issue, how much has it affected shares? And I guess what is the thing that our viewers, investors need to know at this point when they're trying to gauge whether or not this is going to be a catalyst to the upside or something that's going to place the stock under a tremendous amount of pressure?
So what shareholders need to estimate, and it's the question how a yes or no decision is going to affect the motivation and the willingness of Elon Musk to provide his new ideas and his new projects to Tesla as opposed to other corporations. And if they believe that approving the package, that would get him motivated to do all these transactions within Tesla, then they should view that in that light. But if they think that a no vote will get him to shift his attention to the other corporation, that might affect the stock price of Tesla.
Also looking to the desire from Elon Musk to move Tesla to Texas from Delaware. What are the potential outcomes of that, and what are the potential implications of that?
So the move from Delaware to Texas is an interesting move. Another company tried to move to Nevada. It's called TripAdvisor. And now it is in front of the Delaware Supreme Court to decide what is the procedure that you need to go through in order to approve such a reincorporation from Delaware to another state. what Tesla is doing in trying to move to Texas, Texas doesn't have a special court for corporate law. It's not like Delaware with long tradition of precedents and you know what to expect. It might be that some person might think that this decision is a mistake, but you should expect mistakes in any operation of any court. Texas just announced that they are going to create a special court and it's supposed to start in December. Okay, and it takes years until you have a special court. You find the right judges. You start having the precedents and the experience to have that. So my estimate is that the move to Texas, as it is, doesn't really signal that there is something special about Texas law or Texas courts that is the driving force. What I think is going on is that because the factory of Tesla is in Texas, then normally the state where the employees are is always taking care to protect the founders and the leading management of the company against hostile bids, against the activism or against any of this. And I think that's the part that is very attractive about Tesla, to be incorporated in the same place where your factory is, where the government of that state have the incentive to protect you.
Right.
That's what I think is what's driving the move.
Zohar Goshen, it was great to have you here on Yahoo Finance this morning. Thanks so much for joining us. Professor of Transactional Law at Columbia. Thank you.
Thank you so much.
Shares of Dave & Buster's plunging after reporting revenue falling 1.5% in the first quarter. Its comp sales also falling short of the street's expectations, reporting a larger than expected decline, falling by 5.6% from just about a year ago. And here we are, just about exactly an hour into the trading day. We're looking at shares off about 11.5%. When it comes to some of the weakness within this report and digging into it just a bit, clearly Dave & Buster's feeling some of that pressure of the macro environment. That's something that was cited in this release on the call here with analysts last night. And that's also reflected in the quick analyst commentary that we're getting out here this morning following this print. Raymond James calling it underwhelming. Truist raising some of the questions just about those stiff macro headwinds, forced discretionary offering, how much of that is going to offset any of the initiatives that Dave & Buster's has laid out and are working on here over the coming quarters. But despite lowering estimates, the price target here on the stock, we're not seeing too many changes. At least you have Truist there. Price target cut to 64 from 67, so lowered by just $3 a share. So not a huge move here to the downside. But again, I think just material weakness that we're seeing on a macro level is starting to weigh on names and has been weighing on names like Dave & Buster's.
Yeah, and to your point, Jefferies reiterating their buy but cutting their price target and just saying that the street might have been a little bit too optimistic. Have you been to a Dave & Buster's?
I have. I love Dave & Buster's.
Really?
Oh, no, not with kids. No.
Not with
kids.
the kids.
Yes.
That's how I feel. Like, I'm not a mom, so I can't imagine, but I can't imagine going and monitoring the children. That part seems a bridge too far.
Oh my gosh, that would be, that would be stress on a lot of levels. But I've had a heck of a lot of fun at Dave & Buster's without kids. So I mean, that's also an interesting point about this story, right? Because I think there's one side of it where we talk about a lot that people are still spending on experiences. And you would think that a name like Dave & Buster's then would benefit. And I think it has to a certain extent. It's also launching a number of different types of offerings, revamping some of their establishments in order to cater to that need or demand that we are seeing from consumers. But on the flip side, I think people are faced with tough choices. And we talk about inflation remaining very sticky. People are under more and more pressure as the months pile up. And I think as a result of that, we could see some weakness here. And I think that is being reflected in these numbers. But a ton of fun. If you're going to spend your money, I'm a big fan of Dave & Buster's. You won't regret it. I'll put it that much.
We gotta go to the Times Square one. I've only been in Florida, which is probably a unique layer of lots of different personalities and experiences. We are going to move on to another trending ticker we're watching here. Shares of Kimberly Clark rising this morning after Bank of America upgraded the stock from underperformed to buy. Underperformed to buy from Bank of America there. The bank saying the company is on the precipice of structural changes, and analysts there also raising their price target on the name to 160 from 115 here. Now, it's interesting to note as well, taking a look at some of the details within here, they say that the company is taking steps to improve gross margins, including reducing gross costs. They've got additional savings and also supply chain improvements, which is a critical thing as we kind of get to the point where the kind of post-pandemic normalization or return to normal, whatever that looks like, starts to really need to be proven out in some of these earnings print. It looks like they're getting the evidence of that. The analysts also citing opportunities to expand market share through additional innovation and seeing expansion through multiple types of businesses as the company starts to improve moving forward. That price target increase implying an 18% move to the upside for this name.
Yeah, exactly. What you were just saying there, expanding market share, that's actually what stuck out to me within this report, because they're talking about doing that through innovation. They've talked about some of the investments that have been made over the last 5 years. And at least from Bank of America's perspective, they're expecting some of those investments to really start to pay off as the company has been working to, quote unquote, elevate strategy across their portfolio. That has, up until this point, really helped them drive some of that price mix gains that has been able to offset the decline that we've seen in volumes almost across the board when it comes to this sector. It's not just clearly a Kimberly Clark specific problem, but it's something that many of its rivals, many of its competitors within the space has been trying to combat here. So Bank of America making the case that while they do not expect significant pricing power going forward, they do see some room here to premiumize, as they put it, and China remaining a real opportunity here for the company, for investors, as we talk about gaining market share within that region.
Yeah, and it is interesting, the last thing I'll say on this, to compare it to kind of some of the other earnings prints that we've seen from a name like a Dollar Tree sticks out to me. They were talking specifically about headwinds to their paper products, which is what you're going to be getting with the Kimberly Clark. It's your Huggies, your Kotex, for example. So it's interesting to see that kind of bifurcation and to what extent that tells you something about the companies that are struggling with this. Is it a little bit more idiosyncratic to them? Well, we're going to continue to cover all of this and more with more markets action ahead. So stay tuned. You're watching Catalysts.
world leaders are gathering in Italy for the G7 summit, focusing on discussions surrounding things that include global conflict, also the latest developments that we're getting on artificial intelligence. Yahoo Finance's Rick Newman has the breakdown there for us. Hey, Rick.
Hi, guys. So there are a couple of wars going on that they need to be talking about. A couple particular things. There's a continued effort to keep getting more aid for Ukraine, and there's this new idea the Biden administration is pushing to take the profits from Russian investments in the West and basically give those to Ukraine. That's like $50 billion. There's been some disagreement with that in Europe because people there say, well, you can't just, these are investors. They have a right to expect their money back from world markets, but that seems to be moving. Also, obviously, the war between Israel and Gaza. Is there anything more we can do there? And then, yes, artificial intelligence. This has been a focus of these meetings for the last couple of years. They're not going to come out with new rules or anything like that, but they are developing guidelines for how to deal with AI. And the Pope is going to be there. The Pope cares about AI, I guess, and he's going to talk about the ethics of AI and possible ways to use AI to help the world's underprivileged people.
One thing I thought was interesting, Rick, and I want your take on this, is seeing all of those G7 leaders together and all the volatility they're all experiencing. You have Biden heading for re-election, Macron calling for a snap election. You've got Rishi Sunak experiencing really negative polls, Angela Merkel having her own issues. Just a lot of volatility there. Is that something that feels uniquely positioned for this moment where we're seeing a lot of far-right pressures in politics around the globe to you?
This is a thing. Yes. So we've got populism and right-leaning populism all around the world. It's showing up. Guess what? The whole world has had inflation after COVID, and everybody hates inflation. I think that's part of it. Guess what? Migration is not just a problem here in the United States, in the Northern Hemisphere. There's a lot of migration into Europe from Africa and other places. That's a difficult problem. So, we're not unique here in the United States. We tend to think only about ourselves because we're surrounded by oceans. But a lot of the things that are happening here are happening in other countries for sure. And a lot of those leaders on the stage there will not be in office in 6 months. And we don't know about President Biden, of course.
Well, speaking of that election, Rick, another story that we are watching, former President Trump set to meet with several business leaders in Washington today. On that list, we've got Jamie Dimon, Tim Cook. What are you expecting to come from that?
Well, I'm not invited, so I won't be able to report from inside the room. This is the Business Roundtable, which is one of the big lobbyist groups representing corporate America in D.C. This is not a Trump-only event. They're having a big gathering, and they did also invite President Biden to address them, not at the same time as Trump. We're not going to have a mini debate. Biden actually is, given that he's overseas at this summit we're talking about, he's not going to be there. So Jeff Zients, one of Biden's top aides, will address these guys. I think the CEOs probably think that Trump is going to be one of the two nominees in the presidential race this year. And regardless of what they think about him, they have to just deal with the fact that not only is he one of the two major nominees, he could win. That's what the polls are telling us. So I think if they are going to be giving him any kind of advice, I think it would be, we hate your tariff idea. We have enough tariffs on Chinese imports. We don't need another 60% tariff there. Think twice before you deconnect the U.S. and Chinese economies. And we don't need that 10% tariff on other imports either. They are going to say, we do hope you, get taxes even lower than they are now. They're going to complain, 21% corporate tax rate, it's way too high. It needs to be 15%. That's what Trump says he wants to do. Trump also wants to extend all the Trump tax cuts from 2017 so that all these rich CEOs, they wouldn't have to pay more in taxes. And I'm sure they're going to tell him he ought to do that too.
All right, Rick, thank you so much. As always, really appreciate it. Thanks for joining us and hope to have you back soon after you break into that meeting. We appreciate it. All right, we're going to have all of your markets action right here ahead. Another topic we're going to be following here. Could we be entering a stock picker's market? All of that next. You're watching Catalysts.
Softer than expected inflation data, also that uptick that we got today in jobless claims leading to some optimism surrounding a rate cut. We've also seen the reaction play out in the bond market here this morning. Our next guest arguing that the volatility in the bond market may actually continue here in the short term. So now could be a good time maybe to focus on the equity side of things. So we want to bring in Fabiana Fedeli, M&G Investments Chief Investment Officer. Fabiana, it's great to see you again. So I think many investors are out there trying to figure out what exactly to do with their portfolio. We're seeing this conflicting data coming out on the econ side of things. So what would your advice then be for investors today as we are waiting for that catalyst of the Fed to cut rates for the first time?
Good morning, Siona. So absolutely. When you have a macroeconomic backdrop that is still resilient, you have rates arguably at peak, and at the same time, you have about $6 trillion sitting on money market funds. A part of that will flow into fixed income markets at some point. But again, we know the data is very durational, and we know that we could have some volatility in that fixed income market. So a good time to put some money there, particularly on the treasury side, but equities could continue to do well also in the short term. But we have to also consider the fact that equities have already outperformed most other asset classes. And so we need to be a little bit smarter in how we invest in equity markets.
How do you do that then, Fabiana? Where do you find that edge in your investing strategy?
Look, you take cue from what happened during the last earnings season. There were really two types of companies that outperformed. The first one were the ones where you had innovation that really helped beat expectations, particularly when you saw that the expectations weren't as elevated. And then there was a second type of company that perhaps wasn't as innovative, but still expectations were so low that they managed to be beaten by wide margins. So when you look at companies that have undemanding valuations at the same time are bringing some innovation, and you actually just talk about some of the innovation outside of the technology market early in your program, you can actually look outside of technology. Think about healthcare, think about innovation in products in consumer staples, think about industrials. And we are finding companies also outside of the United States. We're finding companies in Europe, for example, in industrials. We're finding specialty material companies in Japan and even in China. And then there's a second type of company that we believe will outperform. And those are companies that actually had inflated expectations as they entered the earnings season. And you've seen some really, really harsh price reactions where companies that even met expectations actually saw very, very negative price action. And some of those companies will still do well on a 6 to 1 year basis. And you see a lot of them also in the US, for example, in IT services and in enterprise software.
Yeah, Fabiana, that's a very interesting point because it's something that we have focused on a lot this past earnings season. And I think my question to you at this point in the cycle is whether or not, do you think that that is a trend that will likely continue here as we look ahead to the back half?
If you're talking about the broadening of the equity market, we believe it will. And in fact, if you think about the Mag 7, the Magnificent Seven that have led the market last year, in reality, only two of them right now in the top 100 outperforming stocks across the world is Nvidia, is the top 2, and then Meta, top 100. But you see in that list companies in the industrial sector, in the consumer staples sector, in utilities. So we do believe that this broadening of the market can continue. But again, you have to be smart. It's about innovation. It's about specific stock characteristics.
Yeah, Fabian, that is a great point and something important for our investors to keep in mind. But I was actually talking about that underperformance that you were just talking about here when it comes to the earnings season, where companies, even if they're meeting expectations, not necessarily being rewarded. And we're actually seeing a lot of pressure here to the downside. Is that something that you think investors need to keep in mind as we look ahead to next earnings season?
Yes, I do think that's the case. You know, we are in a market where there is a lot of concentration on a few big names. Some of it comes from social media. Some of it comes from the fact that there is an increased retail participation. Obviously, retail investors might not have done all their homework and might go to those names that they know and they hear most. But that does leave opportunities out there. And so after the first price reactions, I think you can really take advantage and buy some really good stocks on the dip.
All right, Fabiana, we're going to have to leave it there, but thank you so much for joining us, and the reminder to not be afraid to buy that dip. We appreciate it. Thank you so much. That was Fabiana Fedeli, M&G Investments Chief Investment Officer. Now coming up, Databricks announcing a new AI graphics program that could help them compete with major tech giants. We're going to have more with an executive from the firm after the break. As competition continues in the AI space, Databricks announcing a new AI graphics program that can compete with Microsoft and Salesforce. That business tool will allow users to ask questions about data that'll automatically generate things like charts and graphs based on user data. Now, the data software provider anticipating sales growth above 60% for the first half of this year off of that news. So for more on this, we are going to bring in Salon Tavakoli. He is Databricks co-founder and SVP of Field Engineering. Thank you so much for being here, Arsalan. I want to start with this new data visualization tool. As you know, the leading ones out there already are from Microsoft and Salesforce. What would you say is Databricks' competitive advantage with this tool?
First of all, thanks for having me this morning. As you mentioned, the new data visualization tool that we looked at. First of all, Databricks as a company, our goal is how do we help people get value out of data and AI? Right? And one of the most important parts for folks is that they have all that data and AI, how do they visualize it? The key advantage for Databricks is you have this visualization tool deeply embedded in the entire product. And then on top of that, it's not only visualizing data, but it has the intelligence to understand your data. So being able to answer the questions, expose it to advanced analytics, and help pretty much anybody in the organization be able to get those insights where previously it was a really onerous process for them.
Arsalan, when you take a look at your growth figures, I mean, it's truly astounding. You've got sales growth of just about 60%, rising to $2.4 billion here in the first half of the year. When you talk about that future growth, I guess, one, where's that demand coming from? And what does that tell us just about where we are within this AI adoption cycle and whether or not we are still very much in those early innings?
Yeah, it's a great question. Look, we're excited where the company is, frankly. And to answer your question, as any organization, you're asking, well, who are the applicable customers? And so then you're asking, who are the folks who are trying to get value out of data and AI? And that's pretty much every company you talk to across the planet. That's been the most exciting part. And then from a Databricks growth perspective, it's not just in one place. So one of the beauties of the business is it's not heavily concentrated in any set of customers. It's widely spread out. And so even in our largest customers, we're only a small share of wallet. So you see us still growing heavily in our existing customers and rapidly adding many, many new customers, large and small, to the base. So we're excited from a business perspective that there still seems to be so much opportunity. And I think we're still in the early innings of companies adopting data and AI.
What are you hearing from customers about their ability to adopt and utilize AI to drive efficiency and to kind of protect their balance sheets? Because that's something that a lot of companies are saying that they're using their AI CapEx to do, but I'd love to hear from you what the evidence is looking like.
Yeah, I think, candidly, I think that the excitement is outstripping the reality right now. So I think every single organization has a mandate from the CEO and the board of we cannot be left behind. We have to be diving into AI. And we've absolutely seen that. They're all experimenting. But that switch from how do you go from experimenting something to putting something in production where you're actually tapping into the business value is incredibly difficult. We've seen over 85% of organizations are struggling to actually get into production. And the reason is, I think many people thought it was, I ask a question, there's some big model somewhere in the middle of there, and then it answers the question for me and I'm done. The reality is it's much harder than that.
Right.
One, there's a lot of steps involved, and people have a lot of concerns around, what if this model is hallucinating? How do I make sure that there's high quality? It's very different when, you're asking something from a consumer perspective, can you help me summarize this document or with my kid's college essay? Versus as an enterprise, when you're putting something out to customers where it needs to be far more secure, more efficient, high quality. And so, our main focus has been a lot of those capabilities to help take them from excitement and interest all the way up to production.
Arslan, really quickly here, Databricks is the 6th most valuable closely held company. That was prior to this announcement on increased revenue to come. When are you going to go public?
Look, our CEO has always said that we're not in a rush to go public. We're fortunate enough that isn't a key driver of having to do so. He's always said we'll go public and we'll do it when it makes sense for us. But right now, we're just excited about the state of the business and being able to continue to grow and invest in it.
All right, fair enough. I know a lot of investors are excited and very much anticipating when you guys will, in fact, go public. So Arslan Tavakoli, great to have you. We hope to have you back here on Yahoo Finance. Databricks co-founder and Senior Vice President of Field Engineering. Thanks so much.
Thanks, guys. Appreciate it.
All right, coming up, Wealth is dedicated to all of your personal finance needs. Brad Smith, he's got you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, the latest economic data shows signs inflation is moderating, but it still remains above the Fed's target rate. So we're going to talk about some of the investment ideas to hedge against sticky prices. And investment decisions. How do you pick a sector to invest in and make sure that you're keeping up with its moves? We're going to ask Yahoo Finance contributor Ross Mack for some tips. Plus, the number of Americans filing for unemployment benefits is rising. We'll explain what it means for your job hunt. All that and much more throughout today's show. Big news on Wall Street. The Fed has left its key interest rate unchanged as it continues its mission to fight inflation. However, the Fed did make a change to projections of future rates, the central bank pricing in only one cut this year. Yahoo Finance's Alexandra Canal has more on the dot plot.
Yes, Brad, Wall Street is abuzz with the talk of the Fed and this dot plot, but it's not uncommon to feel a little bit confused when talking about this kind of data. So we wanted to break it down in a digestible way for viewers and answer this one question. What is the dot plot? And to put it simply, the dot plot is a chart that tracks each one of the 19 Fed officials' projections for the federal funds rate. And as you can see here, you'll have a collection of dots from 2024, 2025, 2026, and then longer term here. And essentially, this data is telling us where Fed officials think the Fed funds rate will be heading in the future. It's released only 4 times a year, usually at the end of each quarter, and each dot represents a specific FOMC member, but they are all anonymous. So this dot here, that could be Fed Chair Jerome Powell. This other one over here, that could be Chicago Fed President Alston Goolsbee. The whole point here is that we don't know. Now, if we zoom in to 2024, you'll see 4 Fed officials right up here. They think the Fed funds rate is going to stay where they are. We're currently in a range between 5.25% and 5.5%. So 4, they see that rates are going to be unchanged throughout the year. However, if we look a little bit lower, we see all of these Fed officials think that rates are going to come down. 7 believe that we're going to see 1 cut. 8 think we're going to see 2 cuts. And then if you aggregate the median, that is just 1 cut that is pricing in for this year. And again, this is just a projection from the Fed. And then turning over to 2025, 1 lone Fed official thinks interest rates are going to stay where they are, not come down at all. And then we have this guy all the way down here that's pricing in 10 cuts. And then you have a lot of dispersion here since it becomes a little bit more difficult to predict rates into the future since we don't have the economic data yet. So all of this may seem a little bit intimidating, but this can be a good tool to help you inform yourself about certain financial decisions. Of course, as we know, interest rates affect various investment areas, including mortgage rates, savings accounts, and treasury yields, among many others. But it is important to remember that this is just a projection. It's a guide of where Fed officials think interest rates should go. That doesn't necessarily mean that's where interest rates will go, but it is an important tool when we think about transparency, since the dot plot was first introduced in the aftermath of the 2008 financial crisis, when many investors were nervous about the future path of interest rates. So the dot plot was created to give that transparency, and you can think of it as the Fed's crystal ball of sorts. But again, like I alluded to, there is plenty of criticism surrounding the use of the dot plot. Fed Chair Jerome Powell himself, he has tried to get people to understand that it is simply a projection and should not be taken as gospel, yet it does remain a highly anticipated release every single quarter. Brad.
All right, excellent breakdown. Thanks so much, Ali. We are more than 90 minutes into the trading day, and right now stocks are mixed. Major averages you're taking a look at on your screen here. We've got both red and green territory, as the Dow right now is down by about 0.7%, and fractional declines for the S&P 500 as well. The Nasdaq holding on to gains just barely. This all as it is a huge week on Wall Street. Investors digesting new data out today. PPI, a measure of wholesale prices, showing evidence that inflation is moderating. This comes after May's consumer price index, CPI, as you know it in your household and in your hood perhaps. We also saw that showed inflation cooling. But there are still some sticky areas of inflation, and the Fed is now projecting only 1 rate cut for the year. So here to break down what this all means for your investment portfolio, we've got Burns McKinney, who is the NFJ Investment Group Managing Director and Senior Portfolio Manager. Great to have you here on the program. So, as you're really digesting all of the data that's come out over the course of this week, what is the portfolio playbook that you are pondering or perhaps even enacting right now, Burns?
Well, there certainly has been a lot of very important economic data, and that was a great explanation that we just received on the Fed's dot plot. And one of the reasons we take a little bit of what they do with the dot plot with a grain of salt is that a lot of what the Fed governors are doing is also trying to manage investor expectations. For example, it's easier to suggest maybe we're only going to have one rate cut and then surprise the market with 2 rate cuts than it is to do the opposite. I was on a road trip with my family over the weekend, and I thought the drive might take 4 hours, but I suggested, well, maybe we should expect about a 4.5-hour drive to my family just to kind of help manage those expectations and bake in some room for contingencies. And likewise, we had with the CPI print that was fairly dovish. Inflation is pulling back, and we do expect that the Fed should get room to cut rates later this year. That said, with respect to your question about how investors should position portfolios, we do feel that interest rates, whereas they may be pulling back some, they probably are going to remain a little bit elevated relative to what they've been over the last 10 or 15 years. And so as a result of that, with a little bit higher inflation, a little bit higher interest rates, we're suggesting investors should put their portfolios into shorter duration instruments, areas where you're getting your cash up front and then you can reinvest it. And that makes a great case for stocks and companies that are paying dividends, and really especially companies that are raising dividends, because dividend growth oftentimes is faster than inflation.
Are you seeing investors pile into a few specific names with that theme in mind?
Well, the beauty of it is that investors really haven't gotten there yet. This has been very much of a risk-on market. You still see investors really flocking to what's been working over the last year, which has been your Magnificent Seven and your big high-growth tech names, which tend to actually be the opposite. They're a little bit longer duration, and they've been flocking to those. And what we do expect to see as the Fed starts to maybe finally get a chance to lower interest rates is a little bit of a broadening of investor returns, a little bit more breadth towards, away from that Magnificent Seven and towards, maybe some of that mundane 493, some of those areas of the market that have lagged over the last year, despite the fact that earnings have continued to grow. And as a result of that lagging, you get better valuations than we've had in quite some time in some of those other pockets of the market.
And so with that in mind, as you're thinking about and evaluating some of the forward earnings that you are hearing from companies, what does that spell out for what investors should be expecting as we get into the second half of 2024 and then look even further out to 2025?
We're certainly seeing signs of, despite the fact that inflation's pulling back, we have been looking at a little bit of a Goldilocks type scenario whereby economic growth has been very resilient. That said, some of the Fed rate hikes that we've seen over the last couple of years are starting to have a maybe slower than expected impact, but nonetheless an impact. We've seen unemployment climb to, it's still at historically low levels, but it's starting to come up a bit. You're starting to see, rises in consumer credit card debt. And so, we feel that the economy is probably slowing somewhat, but nevertheless at a sustainable pace. And as a result of that, between that and the fact that investors have been treating things very risk on, I think that the mantra really has been mission accomplished with respect to having a soft landing from these hikes. And so as a result of that, people have kind of moved away from some of the defensives. The way sort of you can think about it is that when the sun is shining, people aren't going out buying. You can actually get umbrellas at a reasonable price. And so some of those umbrella type areas of the market would be things like some of the defensive areas, things like utilities. They've lagged over the last year, and as a result of that, you get great valuations, you get attractive dividend yields that again help investors keep up in an inflationary environment.
Burns McKinney, who is the NFJ Investment Group Managing Director and Senior Portfolio Manager. Thanks so much for taking the time here today, kicking off the show with us. Appreciate it. Well, rates remaining high. This week, Federal Reserve officials scaling back their expectations for rate cuts this year. But what does this decision mean for your money? To break this down, we've got Yahoo Finance's very own Jennifer Schonberger here with us. Hey, Jennifer.
Good morning, Brad. That's right. High inflation pushed the Federal Reserve to hold interest rates steady Wednesday at the highest level in over 2 decades, with few signs the central bank could lower rates soon. For now, the move is expected to keep borrowing costs higher on everything from homes to cars. If you're in the market for a home, it's going to remain expensive for now. Mortgage rates have already backed up on expectations the Fed will hold rates higher for longer. The 30-year fixed rate mortgage is hovering around 7%, just below its recent highs. And analysts say, buckle up and get used to it. The Fed's benchmark interest rate has stood within the range of 5.25% to 5.5% since last July. But mortgage rates track the 10-year Treasury yield, which has been trading in the range of 4.3% to 4.6%, keeping mortgage rates in that 7% range. Meanwhile, rates on auto loans and credit cards have jumped and are likely to remain high as well. But higher rates are good news for savers who earn a higher return on their savings. And while the Fed is holding interest rates steady for now, officials signaled at least one rate cut later this year, with many on the interest rate setting committee penciling in 2 cuts. Now, a 1/4 percentage point cut on the Fed's benchmark interest rate would certainly ease mortgage rates and other loans off their highs, and a second 1/4 percentage point cut would ease that further. But for the Fed to cut 2 times this year, which would essentially be 50 basis points or 1/2 percentage point cut, that's not going to bring mortgage rates back down to those pandemic era lows of 2 to 3%. Brad, we really need to see a severe recession for that to happen.
All right.
Back to you.
Jennifer, let's hope it's not too severe, but we certainly have been discussing with some economists over the course of this morning. Exactly. Thanks so much, Jennifer. Appreciate it. Well, if we learned anything from Wednesday's inflation print, prices are slowly coming down, but Americans are still dealing with high costs, especially when it comes to healthcare. Biden is looking to help consumers get some relief here this week. The Biden-Harris administration announced new actions to protect consumers and lessen the burden of medical debt on American families. Now, the proposed plan would ban such debt from credit reports. Here to weigh in on what this means for you and your finances, we've got Yahoo Finance health reporter Anjali Khemlani. Hey, Anj.
Hey, Brad. That's right. So the Consumer Financial Protection Bureau did introduce this new proposal this week, and it is, of course, open to public comment, and we're going to see what the pushback is on that. But the reason why it has been put into the public sphere is because we know that medical debt continues to be a problem. It was a problem pre-ACA and continues to be a problem now, even with the increased use of insurance. You can see on your screen the amount of medical debt, still more than $10,000 on average. Most Americans are facing that amount and are not able to pay it off. It is impacting their credit, therefore. The protections do cut off at some point. There are credit bureaus that don't necessarily report under $500 in debt, or if you pay it off within a year, it doesn't impact your credit score, but there are longer term impacts. And this has a lot to do with, as you can see on your screen, the map of where this debt is. It doesn't necessarily fully match where Medicaid is not expanded, but that has been one of the issues that folks have focused on, is that Medicaid expansion was supposed to help reduce the amount of debt by allowing those that are 138% of the poverty line to also qualify for coverage at the Medicaid level. Meanwhile, we know the Affordable Care Act has also done a lot to help ensure insured Americans, but there is still a lot going on with that. I spoke to a Princeton professor who told me that it's not just the uninsured that are part of this equation. It is also insured individuals that are contributing to this. You can see on your screen there. Meanwhile, we're looking at what this exactly means. So states have already, and some cities as well as counties, have already introduced some rules and new laws that would help pay off this debt. So New Jersey, for example, one of those states that introduced the COVID funding that it received, and in a one-time shot allowed $10 million to pay for approximately $1 billion in medical debt. It would effectively cancel that debt. Then they're targeted so that it's only those who qualify below or at 400% of the poverty level. And as I mentioned, they're using that one-time shot with the funds. Now, it doesn't fully erase the problem. We still see medical debt as an issue in the country, but some states are starting to do this. The Biden administration has encouraged more states to jump on board. We know Connecticut and Arizona are also also doing this. And so that is where sort of the crux of the problem is. And so while they can't erase the debt altogether, at least keeping it off the credit reporting and allowing individuals who still face that one-time burden of medical debt to still continue getting homes, getting cars, and getting loans, that is the goal of this rule. So we will definitely wait to see if it becomes a rule.
Yeah, especially when so much medical debt is incurred, not knowing what you're fully paying for as well here. So this slightly addressing that issue as well. Anjali, while we have you, there's new data out from the Federal Actuaries Project's Medicare enrollment will drive up annual healthcare spending to $7.7 trillion by 2023. Why is Medicare the culprit here?
So Medicare, we remember, that's the older population. So they need more care, they need more drugs. So it's all a part of the package of why prices are going up. This is why Medicare has been so adamant about trying to fight drug costs. And we know that the aging population is also increasing, and that will attribute to that growth. You see on your screen, not just Medicare, but also private health insurance. So that's the commercial population, which we know is funded through employers in large part, will contribute to this. So price of drugs is an issue, as well as the increased growth. We saw a huge spike in healthcare use because of the pandemic and the increase and the continued use of healthcare services as a result of that. As people got more comfortable, continue to go. There's also telehealth and more ways to access the healthcare system. That is all contributing to the drive up in costs. Right now, the spend, I think, is about 4.8 trillion, and then you're going to see that jump in a few short years.
Wow. Yahoo Finance's own Anjali Kamlani, thanks so much for breaking this down. Very important personal finance matter for a lot of households out there. Coming up, everyone, looking to get into the housing market? Well, we may have some legal advice for you. Free! That's coming up. Are you looking to get into investing but don't know where to start? One option could be to focus on a specific sector. But which sector should you choose? Yahoo Finance contributor Ross Mack joins us now to help and share some of his top ideas. Hey, Ross, how you doing?
Doing phenomenal, Brad. Thanks so much for having me. I think, when a person is thinking about investing and actually going into a specific sector, one, I always want you to own all the sectors, and that's going to start, with an ETF. But if you're saying, okay, my next step is I own the overall sector, now I want to get some alpha, I want to go into a particular sector, I think you always want to start off with what you know, right? What products am I consuming and using on a daily basis? That can be, just your household, consumer staples. That could be healthcare. Another thing I want you to do is actually identify trends. Those trends could be technological, economic. I think we all have heard, what is everybody talking about? What's the way of the future? That might be artificial intelligence. Then another thing you got to understand is, right, what's the cyclicality of that sector, right? What's the demand? What's the elasticity of that, right? If you're thinking about consumer discretionary, ask yourself, when we see inflation or if there's a recession, are people actually going to still be buying these luxury items? Another thing to think about is when we're talking about the way of the future, right? Are there any kind of political or regulatory shifts? I think we've all have heard, how big electric vehicles are, but now you're saying, hey, some states, some countries might be outlawing combustible gas engine cars by the year 2030 or year 2035 or so. So maybe, you can look at it from that way. And another thing, obviously, is just risk assessment. You obviously want to get a sense of just how volatile these particular sectors might be.
All right, Ross, great breakdown there, and certainly a lot to keep in mind as you're identifying which sectors to really lean into based on your own portfolio exposure. Ross, it looks like you wanted to add something else.
Yeah, we got to come back, right? So now if we were to give you an example, right? Yeah. Say we were to look at, and I think the hottest sector on the planet right now is semiconductors, right? So you've been hearing, okay, I don't know what Nvidia is, but I'm hearing about semiconductors exactly. So what do? I think Google is always going to be your best friend, right? So what I would first do is Google, what are semiconductors? Next, I would say, and a keyword with Google is outlook or forecast. So the very next thing I would do is say, on Google, semiconductor outlook. Now you're going to want to read up on it, right? You want to see some reputable names on Wall Street or consulting, right? You might see, and I Googled it today just to see what will pop up. There's going to be a Deloitte 2024 outlook. I would definitely read that. The next thing, especially when it comes to, actually investing in the sector, you want to see what ETFs are actually owning this, right? And so I would literally Google semiconductor ETFs. Then I would literally look at the top 10 holdings. This is always going to be your best friend because you're going to get a sense of just how many people that I deem smarter than all of us, meaning, right, people that this is their daily job, or you want to see, okay, is BlackRock owning this? Is Fidelity owning that? And then the next thing, right, let's see what that top name is. Maybe it is Nvidia. Then you want to go to Yahoo Finance. It literally has some of the best technology when it's all said and done. And actually look at what Nvidia is, look at the charts, look at the financials. You want to get a sense of, year over year, are they growing? And then obviously just put on your Google alerts and you just want to continue to become consumed in it, right? I think we're conditioned in this society to follow our favorite celebrities and our favorite companies. Now, utilize Google for the same exact reason. Utilize Yahoo Finance to really take a deep dive and understand how this company is going to continue to innovate. And that should actually give you some good advice when you're moving forward to investing in a sector.
All right. Somebody must have shown you the Google alerts that I have set up. Ross, I appreciate it. Thanks so much.
My man, take care.
Certainly. Well, buying a house has never been more expensive. According to Redfin, the median U.S. home sale price hit an all-time high of $394,000 in the 4 weeks ending June 9th. But with yesterday's CPI report giving hints that inflation may be cooling, there is some optimism that mortgage rates may become more friendly in the months to come. So if you're thinking now may be the time to jump into the market, you may want to stop and fully think through all of the potential hidden costs and legal issues that you may face. To help us break down those issues, let's bring in Mike Fiffick, who is the Legal Shield provider, lawyer, and managing partner of Fiffick Law Group. Great to have you here with us today, Mike. All right, so a lot of people are trying to figure out if they're going to be paying some of these high average home prices legally, where they need to make sure they're covered along the way. What's the number one legal thought that people should have as they're entering into a home contract?
Well, hi, Brad. It's great to be here, and thanks for having me. Do your homework.
That's what I would say. Do your homework if you're going to be a buyer. Before you get started, I would assemble your team, a realtor, a lawyer that is experienced in real estate work, and a lender, and have a game plan before you start looking for a home, because it is very expensive and it's more complicated anymore these days than it's ever been. Home prices are expensive. The National Association of Realtors litigation is changing a lot about how home buyers interact with buyer's agents and how they're going to pay for it, potentially increasing the cost of buying a home. So it's more complicated now than it's ever been. And having access to somebody that's got experience, like a real estate attorney, is going to be super important for home buyers and give them a real leg up and an advantage in this complicated home buying environment that we're in currently.
And so with that in mind, where are you seeing the biggest hang up that prospective buyers run into in the legal process for buying a home?
I think that they go into it without a game plan, and they don't really understand exactly what they're going to run into. They need to know what to expect. And one of the first complications that they're going to run into is negotiating with their buyer's agent, because they're going to have a contract. That's something new as of August, that home buyers are going to have to negotiate with a buyer's agent. And they may have to agree to pay their buyer's agent a commission, maybe up to 3% of whatever the sale price is for the home. And that's going to be something new for home buyers that it's traditionally been paid by sellers. So that adds a layer of expense. Now, we don't know exactly how that's going to work out as we move forward under these new rules. And the homeowners are going to be able to have some flexibility in those agreements to react to however the deal is rolling down. They may also run into problems with home inspections, problems that come up with title on the property, and they need somebody experienced to help them understand what those problems are, what their significance is, and how to negotiate with the seller in order to get their deal to the closing table.
From negotiation and submitting the first bid all the way through closing on a home, what should home buyers really be prepared for in that process?
They should be prepared for things to happen at the very last minute and have a plan to not allow that to happen. Closings by nature are deadline driven. So a lot of things happen at the very end, and buyers often feel a sense of being rushed, anxiety, and stress because everything kind of comes together at the last minute. And it doesn't have to be that way. You know, if they have a real estate attorney involved on their behalf, that person can sort of quarterback the project and keep them up to date all along the way so that they feel comfortable and know that with their understanding of what's happening in the process, and have some confidence and security for really what is the biggest purchase of their lives.
You know, as we're seeing new homes also take on more of a percentage compared to historical averages of the overall home sales as of right now, as of this year. One of the huge things that a lot of prospective buyers may be thinking about is legally, what should I be concerned more about as I'm entering into a contract for a new home versus the existing home that they may have previously owned or they may be selling in order to purchase a new home?
I think because homes are such a difficult thing for people to afford with higher interest rates, they don't have as much of a margin for error in the event that they buy a home without doing their homework and they run into problems, right? That home has some type of a big defect in the property that wasn't disclosed by the seller, or that they didn't realize whenever they did the inspection. So they really need to spend some time doing their homework. And that might mean asking the seller through the sales agreement to give them more information than it might not typically do, including what's called a clue report, which is a report based upon the insurance claims that were made in relation to that house. You know, that's available to sellers, and buyers can ask sellers to get that and provide it to them. So doing some extra homework so that they don't end up with a surprise after they move in, I think would be really important for people. Because of affordability issues, we also have a lot more people who are buying homes that aren't married. So we've got a lot of co-ownership that's happening now. Couples are waiting to get married longer, or there are more unrelated couples that are buying properties because they can't afford it on their own. So before you would buy a home with somebody to whom you aren't married, it is really important in advance to get some type of a co-ownership or a cohabitation agreement in place, because it is very difficult for unmarried people to get out of a property that they own together, because the laws really don't, there really aren't very many good laws for division of property by unmarried people.
Michael Fiffick, who is the Legal Shield provider, lawyer, and managing partner of Fiffick Law Group. Thank you so much for taking the time here with us on the day, Mike. Appreciate it.
Thanks, Brad. Take care.
Awesome. Coming up, everyone, more Americans made initial claims for unemployment benefits last week than economists were expecting. We'll tell you what this means about the state of the economy. That's next. Being your own boss isn't always all it's cracked up to be. Believe it or not, business owners face a lot of challenges. Not only do you need a strategy for managing personal assets, but you also need to consider what will happen to your business in the long term. And here to weigh in on the stressors and tips for navigating estate planning is Jerry Doyle, who is the BNY Wealth Tax and Estate Planning Strategist. Jerry, great to have you here with us today. All right, so as people are trying to figure out what small business they're going to start, what industry they want to take on and make their name known, how should they be thinking about their own business planning that sets them up best for estate planning as well?
what they should be thinking about overall is a succession plan. Who's going to take over the business in the event they decide to retire? The other thing they have to realize is that there are valuation issues with estate planning in your business. And there are also issues that you have to deal with tax considerations. For example, if you want to sell your business, you're going to have to pay income taxes. If you want to transfer your business during lifetime to maybe your children, there are gift tax issues. And if you die with the business, there are valuation and estate planning, estate tax issues that people all have to deal with. In order to deal with all these things, people ought to have a team in place, which would consist of an attorney, CPA, an insurance advisor, a wealth advisor, an appraiser, things like that. And the most important thing is just to plan up ahead. Keep planning in mind as you grow your business, because eventually it's going to be disposed of.
You know, we've heard in the past from other strategists and people who run some of this planning with small businesses that they should be hiring their family members, putting their family members on the payroll as there's a tax benefit there. How often is that coming up in conversations on your end?
That comes up a lot, and it's complicated because a lot of times people want to get their kids involved, and the kids may not be competent to handle the business. A lot of times the parent, the first generation, has experience, they've grown the business, they know the business, and the children just think just because they're a relative that they have the competency to run that business, and that's not necessarily so. Maybe what people want to do is get the children involved early on, bring them up the learning curve, start them at a lower position, and have them gradually grow into the business so they can take it over at some point in time. But I think the big issue is you want to make sure that if your children are going to take over the business, that they are in fact competent to run the business. If they're not, a lot of businesses want to go out and get professional management, outside professional management.
Jerry, there's going to be a critical time frame that people have to think about, or at least an event in the near future, in the sunset of the 2017 tax law changes there. What do they need to know there?
Well, I think the big thing with the tax law changes coming up the sunset is the fact that the estate and gift tax exemption is going to decrease from the current amount of $13,610,000 down to probably about $7.5 million. And a lot of people are thinking now, well, should I take advantage of the increase in the exemption, roughly almost $14 million exemption now, before potentially it sunsets at the end of 2025. And we've been telling people, you got to think about the fact that the exemption is going to decrease, and maybe you want to be in a position where you use the exemption now, maybe to transfer part or all of your business down to a lower generation before the exemption decreases down to roughly that $7.5 million amount that I talked about earlier. And we've been telling people for a couple of years now, use it or lose it. The problem is that back in 2012, we had the same issue. The exemption was going to decrease from about $5 million to $1 million. It didn't happen. A lot of people made gifts, and when the exemption did not decrease, they had giver's remorse. They wanted to take the gift back, which they couldn't do because it was irrevocable. So as a result, people are looking back at that now, and they're saying, well, you know, I probably want to wait until next year, 2025, to see what's going to happen before I pull the trigger and make a decision. That may be bad advice, because next year, everybody may be trying to do the exact same thing. Attorneys and appraisers may all be very busy, and they may not have time to do any work for you. The other thing people have to worry about, a lot of closely held businesses are what we refer to as flow-through entities. The income flows through from them from their business to their individual income tax return. And what they have to worry about is right now, there's this 20% deduction called the Section 199A deduction. That deduction is going to go away if the sunset actually happens. And that's going to cause flow-through entities to have a higher tax than regular C corporations, which have a maximum tax rate of 21%. So there's going to be a big disparity between closely held businesses and how they're taxed and regular big C corporation businesses, publicly traded stocks.
Jared Doyle, who is the BNY Wealth Tax and Estate Planning Strategist. Jerry, thanks so much for taking the time here today.
Thank you.
Certainly. Coming up, our very own Dan Halley joins forces with an Apple executive to break down the new features, messages via satellites. That's on the other side of this break.
All right, we're here with Kurt Knight. He is the Senior Director of Product Platform Marketing for iOS, iPadOS, and macOS. Kurt, thank you so much for joining us. What can you tell us about satellite for messages?
Thank you. I am so excited to be here. Messages via satellite is a feature we just introduced yesterday. It is part of a set of satellite features that we've introduced over the years. And this is all about when you are off the grid. You don't have cellular, you don't have Wi-Fi, you'll still be able to text and message your friends.
And then I guess, when you're outside of the regular cell phone range, how does it work? How does it pick up what you're doing? How does it know when you're in range of a satellite?
It is absolutely incredible in that the phone can tell when it's off a cellular network. And when you're off cellular networks, turns out satellites are available everywhere. And it's able to talk directly from your phone up into space to a satellite, and then that satellite can then beam the information back down to Earth again. It is incredible technology.
So there's the ability to send messages, but I mean, how many can you send? What can you send? Is it limited to just text?
It's just like sending a message today in that you can send as many as you want. There's not a limitation on it. So you see we've got this prompt automatically on the lock screen. It knows I'm off grid. And so I can just tap here and it's going to bring up this connection assistant. And so in this one space, you can see it actually has found us there in Cupertino, and it has a set of satellite features available to me. Of course, there's messages via satellite. We're going to go into that in just a second. There's Find My. So when you're off the grid, you can still be sharing your location to friends and family. Roadside assistance. So if you've got some vehicle problems, even if you don't have cell phone connectivity, you can still get some help. And then emergency SOS. Let me show you inside of messages, you get this experience right here to connect to satellite. I can bring this up to get a little bit better view of how I need to do. So it does a really good job of letting me know what I need to do to stay connected with the satellite. So I'll close that. I'll go here to send a text message to Alex. And I will say satellite message incoming and send that along. And so right now that is going up to space and back down again. And I'll also go ahead and send an emoji over as well, because you can do text, you can do emoji, both. It is absolutely incredible. Right now it's going 800 miles in space to satellites moving 15,000 miles per hour. As it does it, you see the scent indicator. It's already gone up and down again.
That's nuts.
So Alex sees this. He's already replied to me. I can reply to him with a tap back. There's these new beautiful tap backs in iOS 18. I can scroll over where you can see I can also tap back with an emoji now. I'll do the
cool guy.
Yeah, absolutely. So that is messages via satellite via iMessage. This also works in SMS. So it gets the most broad usage. Basically anyone with a phone, you can send a message to via satellite.
And I guess, what do you see as the use case for this? Is it, I went out hiking, I'm not very good at it, and I got lost? Is it, I just need to get in touch with someone because I went camping and I want to make sure that I can still get in touch with my wife back home?
I think the great thing about this is it's a great expansion of what we've been doing. We've had features before like emergency SOS, which are amazing, life-saving features. And this really broadens the aperture of what we're able to do. You can be maybe out camping and just want to check in and see, maybe how the family is doing. You can just be saying hello, or maybe it's something really important. It's sort of the full gamut of communication, what you might want to use it for.
Thankfully, I only car camp because I'm too much of a baby to do real camping. I guess just as a last, what is it, a subscription service? How does it work in that regard?
So this is part of the set of satellite features that we introduced, again, starting 2 years ago. And as a iPhone 14 or iPhone 15 user, you get a free 2 years of services as part of your phone.
And then you can just go from there if you want to continue on.
And then, we'll announce more details later on how that goes.
Awesome. Kurt, thank you so much for joining us. Really appreciate it. Thank you.
Absolutely. Thank you.
More Americans made initial claims for unemployment benefits last week than economists were expecting, with 242,000 people filing. 242,000 people filed versus the 225,000 expected. What does this tell us about the state of the economy? To explain, we have our very own Rochelle Akufo. Hey, Rochelle.
Hey, Brad. So as you mentioned there, that weekly headline number from the Labor Department showed that initial jobless claims, or that's the number of new filers for unemployment benefits, that hit 242,000 for the week ending June 8th. Now, that's up 13,000 from the previous week, and it did top expectations. Now, insured employment, or otherwise known as continuing jobless claims, for those already receiving unemployment benefits, that also rose 30,000 to 1.82 million for the week ending June 1st. So as we dig into this, though, when it's coupled with a rising unemployment rate at 4%, it does signal that more people are returning to the workforce, but they're not finding a job. And this is part of the reason that polls show this disconnect between how well the economy is doing, while it's increasingly harder for people to find jobs. Now, weekly jobless claims data can be very volatile. Think of things like holidays in between, shortened trading weeks and things like that. So economists do prefer to use the moving 4-week average. But even with that in mind, that also hit the highest level since September at 227,000, with an increase of 4,750. So things trending downwards for Main Street here.
So, Rochelle, what should we take away from this data?
So as I mentioned, there's Main Street, which is obviously the real people who are here who are potentially not able to find work. But then you also have Wall Street, because higher jobless claims are generally a poor sign for the economy. But the Federal Reserve is looking for more consistent cooling in the labor market before it cuts interest rates. It's part of that picture there. And that's something investors have been eagerly awaiting. With that in mind, that will make borrowing cheaper, perhaps make mortgages a little bit cheaper as well. But if you are looking for work, the report does also indicate where you might have a harder time finding a job when you look at the number of people filing. So the list of states with the largest increases in initial claims ending June 8th, that's actually topped by California, followed by Minnesota and Pennsylvania. Now, the largest decreases you saw in North Dakota, Missouri and Tennessee. And of course, when you look at the list of some of these states, those do include some key election battleground states. So when you think of that Main Street, Wall Street disconnect and people hearing all this commentary about the economy doing well, but they're not able to find jobs, it does sort of really paint some of the picture here as to how people feel they're doing in this economy, Brad.
Yeah, I heard you mention my home state of Pennsylvania in there. Rochelle, thanks so much for the breakdown on this. Appreciate it.
You're welcome.
Well, We are just days away from Father's Day. This year, despite inflation weighing on consumers, people are expected to spend over $22 billion, nearly $23 billion during the holiday. But that's slightly lower than last year's record of nearly $23 billion, according to the National Retail Federation. To discuss how to get the best gift without breaking the bank, Michael Horak, who is the Wells Fargo Outdoor Products and Motorsports Group Managing Director, is here with us. Great to see you. You got to break down what we're expecting this Father's Day versus years past.
Hey, first of all, thanks, Brad, for having me. I really appreciate it. I think what we're going to see is a little bit more cautious optimism from the retailers. We've had 3 really wonderful years in a row of sales where consumers are really willing to pay almost anything to get their hands on product. Now the retailers have plenty of inventory at the showroom, so the consumer doesn't feel as compelled to jump at whatever is available. Plus, 3 years of run up on the inflationary numbers have made some of the items themselves a little bit cost prohibitive, and manufacturers are willing to discount a little bit to try to grab market share. So it'll be pretty stable year over year, maybe slightly down. But now with the amount of inventory that's available, smart buyers could probably wait it out a little bit and get some better deals.
Michael, I was just taking a look at some accounts before we came on here. I don't think Dad's going to be getting a boat this year. But if there are other boat adjacent things or lawn adjacent things that you feel like people are going to be gravitating towards, one, what does that mean in terms of the retailers that are poised to benefit? And 2, what are some of the smart shopping gifts that you expect to be perhaps put in play from a kid or, a family level?
Well, for one, we hope that folks still do want to buy the larger boat. There's boats available in all sizes and categories right now. But to your point, the market has softened a bit and the prices have gotten fairly high. What I would suggest, is if Dad already has a boat or an RV or lawn and garden equipment, is to start to really look at the accessories. They do a wonderful job, whether it's a ski boat or a fishing boat. There's all sorts of things you can bolt onto those things. Also, lawn and garden equipment themselves, accessories are very important for safety, whether it's gloves, protective goggles, helmets, earplugs. And those are really, I think, in the strike zone for the kids to purchase for Dad. Plus, it'll help, again, keep Dad safe. And also it won't hurt the kids' pocketbooks too much. So those are the items that I would gravitate towards. And, go into your specialty dealers in your neighborhood, whether it's a motorcycle dealer, your local marina, or your hardware store. They're always willing to help. They're product experts, and they'll know what Dad could use to help complement what he already has in the garage.
It's interesting. I was taking a look at your notes, and there's this rising trend of the outdoor tech dad. You got to break that down for us, and what that means dads are perhaps gravitating towards as new activities.
Well, the outdoor tech dad, really, it kind of centers on a couple of areas. One, there's more and more battery powered equipment out there, right? So dads that enjoy that for a couple of reasons, whether it's the environment, being a little bit, conscious of the neighbors and not being so loud. Those dads like to use battery equipment now. A lot of handheld equipment is battery powered, and more of the larger equipment as well. The area that we're really starting to see take off are the e-bikes, the bikes that are, have battery packs in them. This is really cool for the families. They have, it allows the families to essentially bike together because, everyone has different degrees of ability. Larger folks or, more fit folks can ride the bike a little bit faster, or a pedal bike per se, but the e-bike's the great equalizer. And you can also go on longer distances as a family, go down those paths that are in your neighborhoods and check out things. Another area, if Dad's really into tech, there's things like autonomous mowers that you can actually set into your lawn and allow them to cut the lawn on their own, which is pretty far out if folks of my age, you had never expected that. I was back at the push mower stage when I was a kid. But these autonomous mowers are very popular in Europe. So you can just put them, again, out in the yard, and they'll cut the property on own, and they're very safe, actually. A lot of safeguards built into them, and typically, of course, they're battery powered.
All right, I'm with you, Michael. I remember growing up, and we had a large Toro push mower. You thought I would have.
Same here, Brad.
You thought I wouldn't have needed to go to the gym as much, but still did. Michael Horak, who is the Wells Fargo Outdoor Products and Motorsports Group Managing Director. Thanks so much, Michael. Appreciate it.
You bet. Thanks for having me, Brad. Appreciate it. Bye.
Definitely. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You do not want to miss it.